Good morning. We have breaking news on July consumer prices rising month over month, 0.2%. That is right in line with estimates, Brad, and seeing a year-over-year gain of 3.2%. Those are the headline numbers. Ex-food and energy month over month rising 0.2%, year-over-year rising 4.7%. All of that, again, right in line with what economists are expecting. By the way, you're watching Yahoo Finance. I'm Julie Hyman. That's Brad Smith. Sorry, I'm excited. I get excited when there's breaking news.
We were pumped. We almost hit the sandstorm button right before the show started, just to pump us up coming into this CPI reading here. And some more context on this, the index for shelter, by far, and this should come as no surprise, the largest contributor to the monthly all items increase, accounting for over 90% of the increase. That has been one of the stickier areas of inflation that we continue to discuss with our guests. Interesting here as well, the index for motor vehicle insurance also contributing there. Food index, that increased 0.2% in July, after increasing by about 0.1% the prior month, you'll remember. And then the index for food at home, that increased by about 0.3% over the month. Index for food away from home, all you people going out to brunch and to restaurants and to get something at the bar, yeah, that moved higher as well, just a little bit. That rose by about 0.2% in July.
Yeah, things that stick out to me as rising the most, fuel oil up 3%, although fuel oil sees less demand in the summer months, right? But utilities did see an increase of 2%. All of these, by the way, are month over month increases, so that's pretty large. The biggest drop was in used cars and trucks, so we continue to see volatility in that measure. It pulled back by 1.3%.
Just one more tidbit here, especially as many out there are perhaps on the way to a flight or have taken a flight recently in some of the summer travel that's taking place. The index is for airline fares, used cars and trucks, medical care and communication. Those were among those areas that actually decreased over the month. And so here we're taking a look at the U.S. futures. We've got that pulled up on screen for our viewers at home. And you're seeing futures holding on to some gains as of this morning, with the Nasdaq pointing higher by about 1%. So leading the charge, at least on a percent basis right now. And, well, yeah, on a percent basis.
Yeah, I'm working on opening up the detailed expenditure category. Going straight to eggs, you know, that we've been watching this one for
Cue the egg graphic.
Yes. Yeah, cue the egg graphic, exactly. So I'm trying to look up this, but I'll get back to you on that as I try and piece through these numbers.
It looks like the index for meats, poultry, fish, and eggs, all that combined, that rose by about 0.5% in July. The index for beef, get this, that increased by about 2.4%. So that, at least part of the egg story.
Yeah, egg prices continue to fall, down 2.2% in the month.
Oh, that's good.
There you go. But services, shelter still going up, and that's something obviously that the Fed has been watching very closely. Let's talk more about all of this. We're joined by Victoria Fernandez, Crossmark Global Investments. She's here with us in the studio. Stephen Junot, Bank of America Securities U.S. economist, also joining us remotely as we sift through these numbers and try to figure out what to make of them. Stephen, I'm actually going to start with you here as we look at these numbers coming in line with estimates. So pretty much the trajectory, I suppose, that we have been seeing, and one that the Fed would like. I'm sort of putting aside the year-over-year numbers now and focusing on these month-over-month ones.
Yeah, I think, well, first off, thanks for having me on. And I think that's absolutely right. This is just a continuation of what we saw last month, that we're seeing softer inflation trends. We're starting to really see firmer signs of moderation on the inflation front. And you're seeing it be more broad-based. Yes, you did have that big drop in used cars. It was a little smaller than what we were looking for, and we think we'll get some more in the months to come, and that's going to put downward pressure on future readings. But I think you guys did an excellent job describing the data and walking through it and just pointing out how broad this was. You know, you saw those drops elsewhere. You saw drops on the services side. Shelter is obviously the sticky component, but we know that's coming down because asking rent inflation has been moderating for some time, and that will eventually catch up and show up in the CPI data. So again, this is another continuation that we're moving along the right path when it comes to inflation right now.
So, Victoria, does the Fed do anything with this report?
No, I think this aligns with what the Fed was expecting. I mean, we saw the numbers pretty much match what expectations were. I am a little surprised in the fact that we didn't see the headline number go a little bit higher than what there was. I mean, you look at oil, oil is up 20% from the middle of June till now. So I think it's just been buffered maybe by some of the other declines. You mentioned auto prices going down. And I think the base effects that we're seeing are actually being a very positive effect on CPI right now from a year ago, whereas without being the higher numbers that we were then, we might have a different story right now. Obviously, core is the area of focus for the Fed. They know that it's going to be sticky when it comes to rents. I actually was listening to a number this morning that New York rents are the highest that they've been, I think, in 10 years. So there's going to be some stickiness that stays there. But I think all in all, the Fed probably sees this as fitting into their narrative.
Stephen, one of the things that some folks have talked about is that while we are getting this disinflationary trend now, we could see a little bit of an uptick before the end of the year. Do you expect that to happen? Maybe propelled by one of the things Victoria was just touching on, the fact that oil prices have come back up, but that takes a little while to sort of filter through to everything else.
Absolutely. So to Victoria's point, we're looking for, in the next report, for a much larger energy increase, given the rise in gasoline prices, given the increase in crude, and also natural gas. And then you have some upside risk factors around food inflation as well. Of course, we're in the midst of pretty serious drought that can eventually spill into higher food prices, probably not in the near term, but maybe further out into next year. Then you have El Nino to think about as well. That's another kind of risk factor for food prices, but those are non-core components. So that's something the Fed may look through for the time being when they're judging where's the underlying trend in inflation. And that's where they'll look for core inflation. And right now, the news, I would say, is broadly positive. On core inflation, I would say you may get a little bit of an uptick in CPI, but that's more of a methodology quirk when it comes to health insurance. And that should kick in the fourth quarter. Health insurance has been a big drag on CPI for the last 10 months or so. And then it will start to be a bit of a positive contributor turning in 4Q, just given the way BLS calculates it for CPI. The good news there for the Fed and how they look at the data is that they focus on core PCE inflation or PC inflation, and that isn't subject to the same methodological quirks that core CPI and CPI inflation is when it comes to health insurance.
Victoria, let's perhaps take this conversation to people's portfolios as well. Mm-hmm. If you're reading this report this morning, you're sitting at home, you've got the Yahoo Finance platform loaded up, and you're taking a look at your own portfolio, your watch list, and trying to figure out, is there any trade that I initiate off of this that's different from the strategy that I'd already set in place coming into this report, knowing what the Fed has already said, knowing the trend that you were mentioning that's already in place? Is there any massive kind of repositioning that you make, or is it still kind of the same strategy that many people have employed?
I think you're going to hold on to the strategy that you've had. And I don't think there's anything in this report that is going to take someone, whether they were more bullish or more bearish on the economy, and change their opinion. I think it's since it is so in line, and since we know that going through the rest of this year, we could actually see an uptick in inflation, I think if you were conservative, you're going to stay conservative. So we've been having a balanced portfolio, right? We like a little bit of value. Value actually outperformed growth over the last few days, so we like a little value in the portfolio, but you want some cyclicality because there is some positive news in the economy, right? We're looking at GDP. I mean, Atlanta Fed is saying, 4% for this quarter, which seems a little excessive. Maybe that comes down some, but there's still some positive news there, but we still think we should be cautious. It's going to be quite choppy. We've come down a couple percentage points from the high. I wouldn't be surprised if we come down a little bit more and you get the S&P somewhere maybe consolidating around a 4,300 level. At that point, I think if you want to start making a shift, you can do that. But for now, keep that balanced portfolio in order to kind of ride through the choppiness that we expect.
Yeah, Stephen, we talked to one of your colleagues, Aditya Bave, last week about the fact that Bank of America no longer has this recession call. Like many, we're seeing a lot of other research shops kind of pull back on that. And so, this seems to be sort of in line with what people have been looking for. What then is the biggest risk here going forward? Is it that if we see inflation tick up before the end of the year, the Fed gets more aggressive again? What risks are you watching for?
Yeah, I mean, that's definitely a risk. I mean, the Fed has to take this risk management approach to begin with. So if they're seeing inflation kind of come down on its own, this immaculate disinflation story, we're not seeing really pain in the labor market, you don't get that recession scenario, then how do they guard against that? Well, what we think they'll do is basically they'll be more gradual in their cutting cycle. They'll cut a little slower. They'll ensure that they're going to stay in restrictive territory for longer and put downward pressure on the U.S. economy because they want to make sure inflation doesn't reaccelerate. It could definitely happen. We've been head faked before. We think this is not a head fake right now. What we're seeing is actually, what we've been expecting for some time is just finally coming to fruition, where you're seeing broad-based deflation in goods because you've seen improvement in supply chains. you know that shelter, that biggest component of the core CPI basket, is going to continue to gradually moderate. So that's, kind of baked into the pie, but you have to be a little bit worried that, the resiliency of the consumer can make that descent of inflation, that path towards 2%, that path towards the Fed's 2% target, take a little bit longer. And what that means is that the Fed, absent kind of a downturn in economic activity, well, they're going to be cautious. They don't want to repeat the same mistakes of the 70s, of the 80s. They don't want to force kind of a double dip recession. And they don't want to push the economy necessarily just into a recession if they don't have to. So that's where it really becomes difficult to really fine-tune policy in the years ahead.
Stephen, that's pretty interesting because we've continued to hear even more about the either likelihood or possibility, as you put it, that inflation could spike or move higher once again, even though we've seen the larger trends start to lock in here. What is the likelihood that you would put on that and say that, yeah, sure, some of the signs point towards soft landing right now, but if we do see another spike of inflation, what that would mean for our entire kind of plain landing scenario and analogy that we've kind of just been flying on for a while?
Right. Well, I think when it comes to the Fed, most landings are bumpy, rather than smooth. We've had a few soft landings, 95 probably being the best example. There's a few more in history. We think they're on the right trajectory right now, but you have to be a little bit careful as things progress. The upside risk to inflation probably is just the fact that the labor market is still tight. You still have wage inflation growing at, say, 4 to 5%, depending on what measure you look at. That's more in line with price inflation of around 3 to 3.5% based on what productivity is growing at right now. So that would mean that, yes, we've seen basically that progress kind of towards 3% inflation, towards sub 4% inflation, but getting it all the way down to 2%, that could take a lot more work. And that's where the Fed will probably lean on being restrictive, staying higher for longer, and really just putting that downward pressure on the economy. But that upside risk to inflation, it all boils down to kind of the labor market and wages. If we remain tight for longer, if we remain as tight as we are in the labor market, then you could definitely see some reacceleration in wage inflation. You saw that a bit in the average hourly earnings data recently. Obviously, you've had the UPS negotiations. You potentially have the United Auto Workers negotiations coming up later this year. So there are signs that maybe, you could have wage growth kind of pick up a little bit, and that would put upside risk on the inflation trajectory from a fundamental standpoint.
Speaking of upside pressure here, we have, of course, seen bond yields move up as of late, above 4%. It looks like they're holding above, they're kind of vacillating, but they're might be holding above 4% in the wake of this report. Victoria, how problematic is 4% plus 10-year yields for U.S. stocks?
Yeah, the plus part is what's going to be concerning. So it looks like the economy can take, or the equity markets can take, a 4% yield. We're seeing that right now. We've seen the yields move up for a variety of reasons, though, and I think that's part of the reason the economy is somewhat taking this in stride. Obviously, you have more of a soft landing scenario for a lot of people out there. Inflation has been pushed off further. So those are elements that are making it go a little bit higher. We've had the Japanese yield curve. We had the Fitch downgrade. There's different things that have kind of led to have some higher yields here. But the equity market needs stable bond yields if it wants to continue and have a sustainable move higher. And I don't think we're at calm bond yields at this point in time. I don't think the Fed is done. I don't think they're ready to call the all clear because of the wages and the things that we're just speaking about, potential for CPI to go, and they don't want to take their foot off the gas too soon, right? The double dip recession that we're talking about is a very thing that could happen. And so they want to make sure that they avoid that. I would not be surprised to see another 25 or 50 basis point hike, which means yields could go a little bit higher. That pressure above 4% is going to keep the volatility in the equity market. It goes back to that whole narrative of a very choppy second half of this year.
Great to have you both here with us this morning, breaking down all things CPI plus. Victoria Fernandez, Crossmark Global Investments, and Stephen Janot, who is the Bank of America Securities U.S. economist. Thanks so much for joining us. We'll be right back, everyone, with much more here on Yahoo Finance.
Shares of Nvidia under pressure this morning. Yesterday, the chipmaker unveiled an upgraded AI processor that promises to deliver 3 times the capacity of its current H100 superchip as the demand to run larger AI models continues. Nvidia also announced AI Workbench. Now, that's a space allowing anyone to build custom generative AI models. Open to anyone, the workspace is a one-stop shop where developers can easily access existing models and code, customize them to fit their needs, then deploy them across multiple platforms. The goal? To make AI more accessible. But is that a good thing? Well, joining me now is Nina Schick, author, advisor, and speaker specializing in generative AI. Good to see you, Nina. So, talk about this move, this sort of democratizing of some of these large language models, and what this actually does to competition in this space.
Well, I think it's inevitable, really. If you consider the absolute prowess of the AI revolution, I think what's happening is that we're moving from the so-called information revolution, the internet, the smartphone, cloud, into a new era, the so-called intelligence revolution. And I think the democratization of the capabilities of AI is absolutely essential to reach the real kind of opportunity and potential for artificial intelligence. And the way that NVIDIA has positioned itself as a leader in AI has truly been sensational. I would call Jensen Huang the kind of Michael Jordan of tech CEOs just for this.
So then, by making this move, though, and making it much cheaper, how does NVIDIA benefit then?
So the reason why NVIDIA has been doing so sensationally well is because they have a near monopoly on the hardware to actually compute, to run these huge kind of AI models that are now increasingly going to be a part of all human enterprise activity, or indeed any kind of human intelligent creative work. Like Elon Musk famously said, to get access to these chips, the hardware, it's harder to get access to than drugs. So the fact that NVIDIA has a near monopoly, and of course others are trying to enter the space, Microsoft is trying to build its own chip, and now not only do they have their existing hardware, but they're building an even more powerful chip, is, I think, going to be sensational for the company. We've already seen how well the company's been doing. Its stock, I think, is up over the year by, almost 300%. And I think that rise is going to continue because this essential part of the AI tech stack, hardware, infrastructure, which NVIDIA has a monopoly on, is just going to continue to become even more important and in more demand.
So then, does the growth story from here focus more on business to business or business to consumer?
I think it's going to be B2B as well as B2C. And this is why the democratization element is so fundamental, because so far when you think of AI and generative AI, we've almost been in the last few years for kind of incubation phase where these large foundational models, LLMs, and other foundational models have been being innovated within, usually large tech companies. But now in 2023, as I kind of predicted last year, we really come to the era of exponential growth and mass adoption. So it's not only useful for the enterprise, it's also useful for individuals, for consumers. The key then is that everybody, whether you're a company or an individual person, you need to be able to fine-tune these large models. And really, that's what NVIDIA is saying they're going to be doing with their partnership with Hugging Face, for instance, allowing access to these capabilities as we go into this phase of from incubation to mass adoption.
And so then, as we look at competition in this space, if NVIDIA's CEO, as you said, would be the Michael Jordan of this space, where would that put Mark Zuckerberg and Meta's role in this?
That's really interesting. Obviously, Jensen Huang, he made comments at SIGGRAPH at LA yesterday, where he said, we kind of bet the house on AI back in 2018, and nobody knew. And that really proved to be fortuitous and innovative. Like I mentioned, the fact that NVIDIA just has this monopoly over kind of the hardware of what's powering this AI revolution. And if you subscribe to the view, as I do, that we're only beginning when it comes to the real impact of the AI revolution, that this isn't just a passing fad, their dominance is going to continue to grow. All the other tech companies, however, some may be later than others to the party, but all of big tech has fundamentally reoriented towards AI, and Meta is one of those. Meta, was performing pretty badly last year, in part, I think, with this almost like forced top-down vision of the metaverse, which was Zuckerberg's big bet. But this year, it's strategically oriented towards AI and generative AI, and it has been making strides. Why? Because it's been developing large language models, and unlike competitors like OpenAI and Google, which have been releasing these closed, Meta has been releasing them open source. So again, if you tap into this idea that we're now coming to the mass adoption phase of generative AI, the fact that Meta's models are performing so well in their open source suggests to me that Zuckerberg has been willing to give up a little bit of control for more influence in the long term. So Meta's been doing well, but you can't compare Meta's performance to NVIDIA's. NVIDIA's is obviously far, far superior.
Indeed, because a lot of people are still looking for some of these use cases in earnings reports. So when we think of where the next iteration is going to be in generative AI, as we continue to see NVIDIA rolling out super chips, democratizing this process, what are some of the next catalysts that you're keeping an eye on in this space?
So again, I think you really have to conceive of this moving beyond the kind of exponential technologies of the past 30 years, the so-called information revolution, which has been about building this digital ecosystem, right? Which has become a fundamental facet of life. It doesn't matter whether you're a nation state, an organization, or an individual. You exist, communicate, and act in this ecosystem. With AI, it's again, this idea of an intelligence revolution. All human creative and intelligent activity can now be augmented with artificial intelligence. This is why large language models in particular have been so powerful, because of the way that we can instruct AI to gather insights, to do summaries, to generate and create content for us. So again, think of it as an augmenter of human intelligence that we haven't seen before. And this is why I always think of AI as being different than the exponential technologies of the past 30 years. I actually think it's far, far more powerful. I actually think it suggests a kind of tipping point in our relationship with machines and indeed in human evolution.
And just quickly then, with that in mind, obviously we don't know where this is going, as we were talking about sort of exponential change here. What does this mean for regulation and concerns there, as regulators clearly far behind of the advancements that we're already seeing in generative AI and the potential use cases?
Yeah, absolutely. I mean, I've worked with policymakers in the past, and I think it's very difficult for regulators or policymakers to conceive, let alone come up with a framework to regulate exponential technologies that are accelerating this quickly. That being said, regulators and policymakers understand that this is not just a fad, that we are entering this new era of AI, and that they will have to regulate. And you've been seeing them playing catch up quickly. The EU's been formulating the EU's AI Act that's been in the works for many years. It's going to come into action in 2026. So I think regulators are going to be busy. They have their work cut out for them, but because of the profound nature of this revolution, regulators aside, what we've also been seeing is a lot of responsible leadership and thinking on how to roll out this revolution safely, coming from leading enterprise companies, including some of the tech giants in the US, because regulators can't handle this by themselves.
Indeed, and of course, some of these same tech giants still pushing ahead while also calling for some regulation, still pushing ahead though with these developments. So an interesting double-edged sword there. Great having you on, Nina Sheikh, author, advisor, and speaker specializing in generative AI. Great having you on.
Thank you.
Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live, and here are I'm Julie Hyman. That's Brad Smith. Here are 3 things you need to know this morning. Inflation continues to moderate. July's monthly figure on both the headline and core holding steady at 0.2%. That all-important core number also ticking down on an annual basis to 4.7%. The report likely to encourage those thinking the Fed will not raise rates in September. So is it still too soon to declare victory on price pressures? That has been the line from the San Francisco Fed's Mary Daly in recent weeks. We speak with her exclusively at 11 a.m. Something of a mixed bag for Disney. The entertainment giant reporting fiscal third quarter earnings after the bell that beat expectations, but that really wasn't the story. Shares slid at first, but recovered ground during the earnings call. Cost savings giving the stock a tailwind there. The company sees full year 2023 capital expenditures totaling $5 billion. That is lower than the prior $6 billion forecast. The big takeaways: international parks are doing well, advertising is still bumpy, and Disney Plus and Hulu are getting more expensive and still losing money. And for some, it's the ultimate proxy for the world's second biggest economy. E-commerce giant Alibaba seeing revenue rise 14% on the year in the last quarter. Revenue came in at 234.16 billion yuan versus the 224.9 billion expected. Its overseas results were a tailwind here. Revenue from international commerce surging by 60% on an annual basis. Alibaba shares have had a rocky ride over the last few years, underperforming since late 2020 when the IPO of its financial arm Ant was abruptly halted.
Well, stock futures are higher this morning on Thursday after the release of July's U.S. inflation print. Taking a look at the U.S. major averages, you got green across the screen. Inflation, it continues to moderate. The latest consumer price index report shows prices in July were up 0.2% from the previous month, just in line with June's 0.2% monthly increase. And in headline inflation, you saw that rise by about 3.2% over last year, a slight acceleration from June's 3% annual increase. For more on inflation, we're joined by Keith Lerner, Truist Chief Market Strategist, joining us here live in living color in studio. Keith, great to have you here with us.
Great to be back with you in studio.
Absolutely. All right. So we've seen you walk in the halls here at Yahoo Finance this morning. You've had time to digest the report as well. Your headline thought when you took a look at this report?
Yeah, I think the report was fine. The market sold off for the last couple of days, and I think we're seeing a positive reaction because it wasn't, a negative surprise. I actually thought the report could be somewhat asymmetric, meaning I think if we had an upside surprise, I thought that could lead to more downside. I think the market's having a little bit of a relief that, it's fine. It's as far as in line with numbers. I still think inflation is still not, done. It's still something that the Fed has to watch. The core is still, the four handle is still relatively high, but trends have moderated a lot from where we were a year ago.
Is this enough of a relief to sort of put a bit of a floor under the recent declines that we have had?
For maybe today, listen, I think we're in a chop, and I think we're in a chop for some time. If you think about this market this year, this first half, we came in this year with very low expectations, right? Everyone was negative, and we exceeded expectations from the economy, earnings, and inflation as well. So as we move into this, deeper into the second half, the bar for positive surprises is somewhat higher. So I think we're going to see a lot of back and forth, some backing and fill-in, and just allow some of the fundamentals to catch up with these, really strong gains that we've seen, which is natural, right? It's normally 2 steps forward, 1 step back, and we think that consolidation continues.
I mean, when we think about the areas where there were still the largest contributors to the increases here, 90% of the increase still shelter, and then motor vehicles as well, also contributing there. And so, what do you believe the Fed is going to be looking into in terms of those two aspects of where inflation is still increasing or running hot? Yeah,
so we all know that the rent is overstated in these numbers, and those are going to cool. But I will say, so that's something they're going to look at as well. They're going to look at food prices and also just obviously the core. But there are some other things to watch as far as you're starting to see durable goods or starting to kind of bottom out a little bit. I mean, probably services are going to look at see as services continue to cool. And then wages, right? Wages are still running above 4%. So if you look at the Fed funds futures, the market's saying this is done as far as, or 70% chance of the Fed being done. And we probably think it's closer to 50-50. And we have a lot of data at this point. And at the same time, for Chairman Powell, there's no reason for him to talk softer on inflation until it's done. So we just have, we have several more reports in between the next meeting. But I think right now the market kind of takes this in stride, today's number.
What would be necessary for stocks to lift off again? Would it be confirmation that the Fed is done or something else, some other catalyst, given, as you said, that we've seen a lot get baked in already?
It's a great question because earnings are actually doing pretty well, right? I mean, earnings actually have started on a forward earning estimates have started to move back up. So I think a continuation of that, but we're moving past the earnings season. So listen, maybe there's something from left field that I was talking about. Maybe something as far as Ukraine. There's some positive developments there, but I really think we're more in the camp that it's just going to be back and forth, waiting for another catalyst. You're moving into August and September. That historically, that's a choppy period. The market right now, the good news is, earnings have continued to come up. We've had a mild pullback, so valuations have reset a little bit, not cheap. But it's hard to say beyond, just investors who've missed out jumping in, hey, what's the catalyst for a big move up from here? We think that 4,600 level near term for the S&P is going to be somewhat formidable, at least short term.
So now I'm going to ask the flip side of that question. What's keeping you up at night? What's the biggest risk to the market right now, particularly one that maybe people aren't seeing?
Yeah, I mean, I sleep pretty well, except last night in a hotel room. But I think right now we have more good news that's been priced into the market. So let's just say we had a nice a decent inflation print today. If we start to see that move up, I think the market's not prepared for that. And let's say the Fed has to go another quarter point or another 2 hikes. I think that's something that would be unexpected. And you also, with the market where the valuations are, you're somewhat vulnerable to bad news. Now, sometimes we just don't know what that news is. What the headline is tomorrow that shakes the market up is often a surprise. So I just think, maybe one point there I would bring up is just, the economy, right? I mean, everyone over the last week or so, you've seen a lot of economists now scratch the recession call. And I think, keep an eye on those initial jobless claims. We saw this morning, they kind of popped up a little bit. If you start to see the economy weaken, maybe it is kind of delayed when everyone is basically throwing in the towel saying that the economy is still resilient. So again, it's just something to watch.
Is there a data point within the economy that we're not paying close enough attention to right now?
I think the inflation numbers are really important, and I just think keeping an eye on the weekly initial claims along with credit trends in the market. And the credit trends, as far as when you look at the bond market, spreads are pretty tight. Actually, in our view, somewhat complacent. But those are the things, as far as the real-time indicators, that we're keeping a close look at.
Yeah, and to your point, initial jobs claims this week, 248,000, or last week, I should say, 248,000, which was an increase from 227,000 the week before. Keith, we want to turn to another topic, and that has to do with big tech. As data has taken a back seat in driving markets, hype around artificial intelligence and big tech has taken over. Is that still going to keep going? It's been a tough month so far for 2 of the biggest names in tech, Apple and NVIDIA. Both stocks have pulled back. They're possibly heading into correction after posting massive gains in the months prior. Keith Lerner is still with us. Keith, tech is one of the sectors you like. So presumably you're not so worried about the pullback in some of these large cap names, or how are you framing your thoughts around it?
We upgraded tech in March, and the way we're thinking about tech is, as you think about it intermediate term, if the economy does slow down somewhat, we still think some of these rate hikes are going to have an impact. I think it's been delayed. That companies are going to continue to have to pay on tech spending regardless, so just to keep up with the competitors, or they can be left behind. So I think tech's okay. I think the problem with tech, as we all know, it got top heavy. We had 40% gains in the tech sector. And I also think it needs a resting period. So, I mean, short term, after Apple's earnings last week, it feels a little bit heavy. So we just think it's also going to be, consolidating here. I think the overall long-term outlook looks stronger. Technical trends have weakened here a little bit. And I think that's the other challenge with the market. You asked earlier, what's the catalyst to move this market much higher? You need tech to re-engage, right? Because tech, communications, discretionary are about 45% of the market. So if you say what's going to move the market higher, you need that to re-engage. Maybe the big catalyst to be watching is, I think August 23rd is NVIDIA's earnings, right? That kicked off wow, this AI is really potentially real in some ways for earnings. So they have a high bar to pass, but that's the other thing we'll be looking for. And in the interim, what we've been doing really since June, the average stock, the equal weighted index, had underperformed the S&P on a 3-month basis by the most we've seen in about 30 years. So what we've been doing is say, hey, S&P 500 still fine. We still think there's modest upside, but pair that with something like the equal weighted index, where you have not so top heavy, which are trading around the 15 multiple, has had a lot of underperformance and maybe a little bit mean reversion. And you're seeing over the last week or so, also financials acting a little bit better, energy acting a little bit better, and that should benefit something like the equal weight index.
I mean, there's a lot of kind of a show me narrative now that investors are applying, even with the AI narrative that had been driven in the hype phase that came in the previous earnings period. And so now in this one, it seems like there's a little bit more scrutiny around, okay, when is this actually going to trickle through to your bottom line for some of the tech companies?
Yeah, you're right. I mean, at the end of the day, I mean, the hype is there, but after a quarter, 2 quarters, 3 quarters, it's like, show me the money, right? Show me that in earnings.
And how much is going out
and how much, and I think we all agree it's revolutionary, and what you do, what I do, is going to be supportive for a lot of, there's going to be a lot of great productivity gains, but how does that translate in earnings? And, our tech analyst mentioned with NVIDIA is capturing the majority of that AI earnings boom right up front. Where do we see the follow through from others? So again, we think it's a positive. We think that the valuations will stay somewhat higher than normal because of that expectations, but those earnings may not be coming through right away. It's going to be a longer term process.
And you are keeping your overweight.
Yeah, we're keeping our overweight. I mean, again, on a short term basis, some of our tactical strategies, we're keeping a close eye, but someone has an intermediate time frame, let's say, 12 months, we still think tech is just fine.
And then another one you're overweight, not as sexy, industrials. What's the thesis
I think
behind
industrials is very sexy. I mean, it really benefits from a lot of secular themes. I mean, one, onshoring. We've seen a massive amount of spending back in CapEx here because of the onshoring. And then the other thing that's still underappreciated, a lot of these stimulus bills, as far as the IRA, the CHIPS Acts, there's so much kind of stimulus that's still in the pipeline that hasn't even gone through yet. And I think that the industrials will be a beneficiary of that, not just this year, for several years. And then also defense spending, right? We still have the strategic battle with China. So defense spending is starting to ramp up as well. So I just think it's a diversified area that benefits from some secular trends. And I really think that's long-term leadership. By the way, an interesting factoid is 2 sectors actually made a new all-time high over the last month or so, and that was tech and industrials. To me, that's a sign, especially with industrials, that's probably longer-term leadership.
And one other area as well that you're focused in on, and we've heard even more calls around this recently, small caps, and the comparison here of U.S. small cap or global U.S. small caps versus some of the large caps out there. Why is that?
We're staying with the large caps. We've been overweight large caps. We're neutral small caps right now. And the way we think about it is this: small caps are cheap. They're at a really cheap valuation relative to large caps. Valuation is not a catalyst, though, right? So when we look at, for some of our clients that are looking at 5 and 10 years, and our work suggests small caps will outperform, a higher probability. But on a short-term basis, I think some of the business cycles working against them. And don't forget, a lot of these small companies, they're more affected by these higher interest rates, right? So they're not as diversified businesses. So again, neutral shorter term, for folks that have a longer term outlook, we definitely think there's a part in a portfolio, but we just don't expect near-term outperformance.
And then one other area that sticks out to me is consumer discretionary, that you guys are overweight. And this one's really interesting to me because there's some headwinds, it feels like, in consumer discretionary. The student loan repayment coming back. There's been quite a big uptick in promotioning, at least when I think about retail and apparel specifically, although I know consumer discretionary is bigger than that.
Yeah.
So
it's an interesting sector because we say the consumer discretionary, and then you say what's in there. It's actually I call it a quasi-growth sector because your biggest holdings are Amazon and Tesla. So when you think about it, we kind of put that in the growth aspect, and those weightings in that index is so high. So it's not as straightforward as just saying, hey, if you think the consumer is going to slow down a little bit, why would you be positive on discretionary? So I think it has a mix, and some of those areas outside of those 2 big cap stocks, they've gotten beaten up pretty well. So again, I think overall and we just saw Amazon had a really strong report. Again, not recommending individual stocks, but it's helping that sector as a whole.
All right, a lot of sectors we've covered here today, and it sounds like we're going to fire up the hat machine, make industrial sexy again. Keith Lerner, thanks so much.
Can you help me?
Chief Market Strategist over at Truist. Thanks so much, Keith. Great to see you.
Great to be with you.
Absolutely. Everyone, we are also watching Alibaba this morning. Got to talk about this one. The Chinese tech giant posted solid results for its June quarter, reporting a 51% year-over-year increase in net profit, driven by revenue that rose 14% year-over-year. Now, the e-commerce company that topped analyst expectations, even as economic growth in China has wavered. But Alibaba's push into overseas markets is boosting results, with revenue from international commerce retail surging by 60% year over year to $17.4 17.14 billion yuan in the June quarter here. Now, a few things to break down just briefly here on Alibaba. This is, of course, important to remember that they have the different kind of businesses that they've broken out into, all aligning under and the 6 major businesses, all aligning under Alibaba in this reorganization. And one of those that caught my eye particularly and should continue to catch investors' eyes is that cloud segment, because that is on a revenue basis the second largest performer there. And they've been trying to make sure that Alibaba's cloud business continues to grow even more into the Western Hemisphere. Now, with some of the kind of larger concerns around where some of the deglobalization efforts that have been put forward, or at least the environment, where that actually kind of puts a little bit of a cap on some of that growth ambition, at least in this near term. But for Alibaba and that cloud business, you did see, I think it was about 3%, 4% year over year growth in that business. And then additionally here, just looking through where in the Taobao and Tmall group, part of that larger kind of e-commerce consortium, that too continuing to see just solid growth. And you think about the reopening trade that a lot of people had looked at within China, and particularly for e-commerce. This is a company that directly would benefit from that if some of the spending were as strong as the projections were coming into the start of the year.
Although to your point, it's interesting how international business also did well. Investors are still sort of trying to figure out what to do with this company now, given that it is going to be sort of splitting up here. David Zhang, who led the company through this conference call, this is, I believe, his last one as CEO. He's going to be leading the cloud business. So that's something that people are considering here. So it just, this is a company that is in flux, whose parts are obviously as large alone as many other large companies. So it just, they're trying to figure out what to do with it.
Yeah, absolutely. So taking a look at shares of Alibaba, our viewers saw that moving higher by about 3% here pre-market. We'll see exactly where that continues to trend towards.
They're up like 7%, year to date. So we've seen a little bit of a gain, but not a huge one.
It's been a wild year for them.
Yeah. It has. All right, let's talk about Disney. Speaking of wild years, Disney, the latest streaming service to hike prices and crack down on password sharing. The media giant shifting focus to capitalize on existing subscribers, with CEO Bob Iger telling analysts on the earnings call that the company is aiming to migrate more subscribers to its ad-supported option. For more details on the call, we're joined by Yahoo Finance's Alexander Now. Ali, what stood out to you from the call?
There were quite a few things that stood out. I think number one being the fact that we are going to see price hikes again for the second time in a year. And I think for most consumers, they're thinking to themselves, what the heck? We now have all these streaming services and they're getting more expensive. And these price hikes are pretty significant. The price of Disney Plus, that's going to go up by 27% to $13.99 a month in the US. That's up from the prior $10.99. And remember, when Disney Plus first launched in 2019, that price was $6.99. So now we're pretty much double from those levels. Hulu, meanwhile, those prices are going to increase by 20% or $3. So, this is coming as Disney is trying to pare down some of those losses, especially those streaming losses, and increase those profitability levels. That did happen in the quarter. Disney reported streaming losses totaled $512 million in Q3. That's about half of the $1.1 billion loss that was reported in the prior year period. And that was also significantly ahead of estimates. So a positive thing there, but probably a negative for consumers, is the fact that we will be seeing a Netflix-style crackdown on password sharing. So to me, this is a sign of what's to come from all the streaming giants. Bob Iger did talk about this a bit on the call. Here's more of what he had to say.
We are actively exploring ways to address account sharing and the best options for paying subscribers to share their accounts with friends and family. Later this year, we will begin to update our subscriber agreements with additional terms on our sharing policies, and we will roll out tactics to drive monetization sometime in 2024.
So 2024, the password sharing crackdown coming to Disney Plus users. And then another key thing I want to mention is the parks business. Bob Iger did say that there's been some softness when it comes to Disney World in Florida. And that's due to a few things. One, the fact that we've seen tourism slow. We've also seen a strong US dollar that has discouraged travel from international guests. In addition to the fact that we've seen a decline post-pandemic when it comes to that pent-up demand. So not as much demand as there used to be. That being said, though, we did see the parks, experiences, and products segment surpass revenue expectations in the quarter. Operating income also came in strong, $2.43 billion. That's ahead of estimates and also ahead of what we saw in the prior year period. International parks, a large part of that story. And then finally, when it comes to ESPN, we didn't get too many details on that, but we do know that Bob Iger is super committed to bringing ESPN fully over the top as a direct-to-consumer streaming service. He talked a little bit about that Penn Entertainment partnership, about how Penn was very aggressive in their approach, and that's why they went with them. So we'll see what's to come from that.
All right, so we're going to know your vibe check from this call.
I would say the vibe check is fine. It's fine. I think from an investor perspective, you know, we've seen shares go up. I do think it's encouraging that we have losses going down, and they do seem adaptable, right? Disney seems not to be so tied to what they said they were going to do, like sports betting, for example. Now they're embracing that, so they're willing to pivot in the name of profitability and in the name of paring down those losses. I do wish we got a bit more color and a bit more detail on ESPN, possibly some of those strategic partnerships. Bob Iger, he didn't spill his guts like we've seen him do in recent interviews. So I wanted a bit spicier of a call, but overall we did get.
Name me the last spicy earnings call you guys heard besides Tesla. Tesla x Tesla.
Spicy?
Yeah.
That's true.
And for Vibe, we also have Vibe check the shares, right? The shares are up 2.3%, which I think also is
contributes.
Fine.
Yes,
it's
which
fine.
is fine. So
Last quarter.
That's my take.
Yeah, that was spicy.
That was spicy.
Yeah, it had spice.
The news was spicy.
Had seasoning.
Okay,
yeah.
all right, fair enough. All right, Allie, thanks.
We're going to come back and rate the spiciest earnings calls.
I'm just trying to manage your expectations,
That's true.
guys.
I know.
That's all. Thanks so much, Allie. Really appreciate all your coverage of Disney and doing double duty on CPI today. Yep. Also, if you look at YahooFinance.com. Yes, exactly. All right, much more coming up, including the opening bell and more movers. You're watching Yahoo Finance.
Fine. This earnings season, has it lived up to expectations?
I think it's been fine, but I think it's been a little bit soft. So I think the problem is we got used to all these positive surprises and coming out feeling really good, and we just haven't had that.
Novo Nordisk reported second quarter earnings, lifting sales guidance for the year on its blockbuster diabetes and weight loss drugs. Yahoo Finance Anjali Kamlani has the details for us, but there is a fly in the ointment. They're sort of a victim of these drugs' success.
Yes, they are. And as you noticed, they missed on Wall Street expectations, in part as a result of having to curb, their output of these drugs. But let's break it all down. You saw the numbers for the earnings. Let's get into those obesity drug sales. While they did bring in $1.57 billion for the quarter, they have already had to curb their output, especially of lower dose products, in particular Wegovy. So while they did say sales were up 30%, they did show increased operational revenue. They are predicting and upgrading their guidance for the year between 27 to 33% for sales and 31 to 37% for operational growth. They are also looking at still maintaining some sort of restriction, especially in the U.S. But there were some surprising numbers there. If you want to take a look at what the U.S. market looked like, it did have account for 44% of all GLP-1 products. Now, GLP-1s, let's just recap what that is. That is all of their obesity and diabetes products. So that includes Wegovy, Ozempic, Rebellious. Those are the ones that they have out there on the market right now for both. And they are not a new class of drugs, but the new formula of these drugs that are really driving these blockbuster categories. So GLP-1 sales in the U.S., 44% increase, and internationally 62%, and that is still with a restricted market. So kind of interesting considering, what the expectation is, what the demand is. You heard repeatedly on the call this morning that, company officials are looking at increasing manufacturing output. They've already had to add an additional line from what was expected. So they'll have a total of 3 manufacturing plants for these products alone. And that's where the demand is coming from. Ozempic already giving them a record year last year. And then now Wegovy, especially with their new results for the cardiovascular benefit, really boosting sales and expected to boost sales for the year. So all things considered, still a slow ramp up on that Wegovy product. Internationally, it's not available as widely as here in the U.S. They're also reducing the amount of lower dose product that's available as a result of the demand to ensure that once patients are on the product, they can actually titrate up to those higher dose levels. So a lot going on for the company. Mixed results on the downside, 18% reduction in their rare disease segment of business. So that sort of balanced out and helped contribute to those lower than expected results. They have had some manufacturing and production issues, just as for the weight loss products. So that's sort of the mixed bag picture that you see for this company right now.
And Anjali, we could leave it there, but in the words of the late great Billy Mays, but wait, there's more. You're also watching shares of Illumina. Despite topping the street's estimates, the company cut its sales and profit outlook for the year. Tell us what we need to know there.
Yeah, Illumina is one of those stories. I mean, for swinging away from the opposite end of the spectrum, Illumina has had a lot of trouble this year. We know, of course, the fight with Carl Icahn, of course, has been weighing on the company. That Grail acquisition for $8 billion from 2021 and the sort of spinning out of that once again, or the need to, as a result of both U.S. and EU regulators really talking about the concern there with acquiring it before it was approved, $470 million fine. CEO left in June, a 10% cut in their research and development segment in July. A lot of stuff moving to the downside. They also expect lower than expected sales of their latest sequencer. They've also been impacted by the waning COVID demand. If you looked at their numbers, $6 million in their revenue from COVID sequencing compared to $27 million in the quarter in 2022. So it's huge, decline for them. So they're under a lot of pressure there. Even with the Grail acquisition, they have not changed the outlook for that. 90 to 100 million of income there for the year. So a lot of negatives for that company as it goes through sort of a reorganization. They also announced 2 more executives leaving in the last quarter. So again, a lot of pressure on this company, on this stock. It has had a tumultuous year, to put it mildly. And then they're not expecting any massive annual growth, sticking to 1% increase for the year. And that's a drop from the about 10% they had predicted at the beginning of the year. So like I said, pretty negative news there.
Yes, indeed. And that it's been a fascinating story to track. There is one more thing that you are tracking that we want to touch on, and that is the new COVID-19 variant that has been increasing in velocity. It's being called informally ARIS. What do we need to know about this latest variant?
Maybe too harsh a name for the trouble it's causing right now. Not the goddess of discord and strife just yet. It accounts for about 17% of cases that are being sequenced here in the U.S. Of course, that is with the decreased sequencing that we do have. We have seen increased cases based on wastewater surveillance here and in the U.K. That's really where the major concern is. But it's mostly just a variant to watch out for right now. That's where the World Health Organization declared that. Something to watch, essentially. No major shift in symptoms or any other concerns right now. But of course, this just goes back to, it's not over yet. This is also, sorry, I meant to point out, this is also a variant of the Omicron family. So that also is continuing what we know as the sort of dominant strains, if you will, right now.
Whew. All right. Good to know all of this. Thanks for covering all of this for us. Really appreciate it, Anjali. We just saw the opening bell on Wall Street, so let's do a quick check of the market sponsored by Tasty Trade. We've got stocks that are back in the green today, perhaps reassurance on the CPI front that the numbers were indeed in line with estimates. We did not see hotter than estimated inflation. The Nasdaq ticking up by 0.9%, leading gains here as we accompanying by that CPI number. We don't see any kind of meaningful tick up in bond yields, so that allowing tech to rally once again. S&P and Dow also on the rise. What are we seeing over at the Interactive, Brad?
Yeah, seeing the Dow Jones Industrial Average up 0.8%, as you were mentioning a moment ago. This is a look at the past 3 months here, but let's take you perhaps to the past 4 days, which should get us caught up to speed on this week. Overall, past 4 days, we're up by about 1%, and some gains here today, as I mentioned, for the Dow, of about 0.8% out of the gate this morning. Past 4 days, though, hasn't been a good stretch for the Nasdaq Composite there. You've seen some pressure on some of those mega cap tech stocks. Most notably, Apple has been in focus for a lot of investors with the correction that has ensued there. We're taking a look at Nasdaq, though. Right now, the Nasdaq Composite up by about 0.8%. We'll get a look at the Nasdaq 100 in a hot second for you folks. I know you're clamoring for that at home. S&P 500, you're seeing that up by about 0.7%. Past 4 days, still holding on to gains by about 0.5%. Quick look at the S&P 500 sectors here, as we always do. We'll keep that consistent for you. Taking a look at the intraday activity, all of them are in positive territory, so we won't spend too much time there. Looks like communication services and consumer discretionary holding on to, or at least moving those gains higher, the outsized leaders there. And then lastly here, the Nasdaq 100. We'll take a quick look at that. More green than you can imagine on the screen right now. Just a few red spots here. NVIDIA, one of those, flat just barely to the downside. However, the deal that has rocked the markets today, or at least the high-end luxury fashion part of the markets here, some of our trending stocks, and we're going to talk about this just a little bit more, but we're just going to check in at the open on Capri Holdings. Of course, a major deal announced there. Capri Holdings moving higher by about 56%. That company and the acquisition that is ensuing, Capri going to be acquired by another company that is also, of course, in the trending tickers on the Yahoo Finance platform, Tapestry. You know them, you love them at home, perhaps you wear them. You're seeing those shares. Of course, this is a typical move, as you would see the company making the acquisition, moving lower, and the company getting acquired in Capri Holdings moving higher by about 56% here out of this off of this deal. Over $12 billion is the combined company is what they're hoping to generate, and nearly $2 billion in adjusted operating profit the prior fiscal year. And so we'll break that down a little bit more.
We will. It's an $8.5 billion deal. That's how much Tapestry is paying total for Capri. We're going to talk to Simeon Siegel of BMO a little bit later. I'm calling this like baby LVMH that they're trying to create here in the U.S., much smaller than the actual LVMH or Kering for that matter over in Europe.
Versace.
Yes, we'll talk more about all of that. We are also watching shares today of Plug Power, the stock falling by almost 12% after the hydrogen fuel cell technology company released its second quarter earnings report. Margins were challenged for the quarter, but revenue did come in at $260 million. That was ahead of analyst estimates. The company reported a loss of 40 cents a share. That was wider than the street expected. And most of the commentary here, Brad, does seem to be centered around the margins, which weren't just weaker than expected. They were a lot weaker than expected here. Looking just at some of the commentary, JP Morgan saying the revenue beat was indeed somewhat offset by those margin headwinds from elevated hydrogen pricing and investments that were made to scale up the company.
Yeah, indeed. And we're taking a look at shares right now. They're actually down by about 11.6% as you were mentioning some of the results a moment ago. And anybody who's been tracking the stock over the course of the year, and we've had actually the pleasure to speak with the Plug CEO over the past couple quarters here. But over the course of this year, just looking at some of the reaction and the movement, it's down 23% year to date. And so you got to imagine where, in terms of the new opportunities for this company to move forward and not just connect some of the consumers out there with the Plug Power solutions, but at the same time, where in some of the investments that they're making, investors might be paying closer attention to as they're trying to ramp up their own distribution ability too.
Yeah, and it's interesting as well in an environment where a lot of money is flowing from government coffers, either in the form of incentives or direct grants, to companies like Plug, that we have not seen better stock performance from this company.
It's not every day you see liquefaction on a lower here, so I had to take a look at exactly what that means here for Plug Power.
Cryogenics and liquefaction as revenue drivers. I don't know enough about the company to know what that means, to be honest.
It's in the weeds or in the liquids for sure. Six Flags. This is a company I'm a little bit more embraced with. Six Flags. They took a nosedive down to the trough of the roller coaster this morning after it missed expectations on its quarterly earnings. CEO Salim Basoul, however, did say that the company is seeing a return to solid growth trajectory in attendance, revenue, and earnings. Shares down 0.4% right now. And I was taking a look at this report earlier today, and one of the things that pops out to me, and the timing is great around this. You had Disney last night give us a little bit of the insights around their parks and resorts business. Ali Canal broke that down for us earlier in the show. And now you got Six Flags reporting this morning. They said that delighting their guests, of course, continues to be their number one priority. But there is so much investment that this company is making. They're sensing challenges, and you kind of hear that coming through the management team right now. They're investing significantly in park infrastructure and beautification, quite different than liquefaction. And they've introduced an exciting lineup of new events. And so it'll be interesting to see where those events perhaps catch hold with some consumers. Park experiences are not cheap. And so if you're thinking about a consumer that is being more cognizant about where that spending, even if it is in the experiences economy, where that spending is going, is the first dollar that you're thinking about spending going into Six Flags, or is it going elsewhere in that experience?
Well, it's a spectrum, right? Because we learned it's not necessarily going to Disney World in Florida. So if you're not traveling, maybe Six Flags is closer to you and you're spending on that. What the company did see in the quarter, attendance did rise by 6%, but that was a smaller increase than estimated. As always with this kind of thing, weather's also a factor, and that's something that the company pointed the finger to as causing some headwinds for them during the quarter. As you mentioned, they did tout some upcoming events. They have stuff around like Halloween, for example. So they're going to be trying to push.
Always fun.
I think there's a Boo Fest, a Fright Fest.
They changed it?
I don't know.
It was Fright Fest when I was growing up, I think.
Now I have to look at their press release
Boo
to
Fest.
see what they called it.
They should save that one for Valentine's Day.
Boo Fest, Kids Boo Fest, Oktoberfest Food Festival, Fright Fest, and Holiday in the Park.
Yeah, Boo Fest should be a Valentine's Day thing.
Boo Fest is also a Curious George movie that was a beloved one in my household, with my kids when they were growing up.
Interesting.
Yes.
All right. Well, we'll see if people go into the park and they spend more during Boo Fest. As of right now, though, they're in this most recent quarter. Total guest spending per capita was actually down 3% year over year.
Yeah.
All right. Well, all your market actions straight ahead. Stay tuned. You're watching Yahoo Finance.
Boo.
Boo. When you think about the bellwethers that we've seen over the course of this earnings season, is there one that kind of takes the cake?
I think that in large cap tech, things have been fairly mixed. There's been some good and there's been some bad. The growth trade is fighting back, trying to keep leadership, but the value trade is putting up a pretty valiant effort to take it over, and the growth stocks haven't made it easy.
inflation continues to moderate. July's monthly figure on both the headline and core figure holding steady at 0.2%. That all-important core number also ticking down on an annual basis. The report is likely to encourage those thinking the Fed won't raise rates in September. Joining us now to break this all down, we've got Yahoo Finance reporter Jared Blickery down there on the floor of the New York Stock Exchange. I mean, I can clearly tell people are reading into this down there on the floor, Jared, and just running around telling all their friends.
There is actually a bit of excitement on the floor today. Don't know if it's CPI, maybe they're excited about a couple tickers, but nevertheless, it is nice to see people down here. But I do want to talk about some of the subcomponents of CPI, especially in energy, and I'm looking at the Wi-Fi Interactive. We have a couple of these broken down. These are month-over-month changes. Fuel oil, that is up 3%. That's 300 basis points in 1 month. That is a large amount. Gasoline, 0.2%, quite a bit smaller, but still going in the wrong direction. Utilities up 2%. That's 200 basis points. And only electricity moving in the right direction, and that is down. That is down about 0.7%. But a lot of these subcomponents, including fuel oil, gasoline, these guys are down 20% or so year over year. So we're looking at market declines in the year over year numbers. But my concern is that with these incremental gains in the monthly figures, have we bottomed? Are we in fact moving up again in inflation, especially with respect to these energy prices, which have experienced some moderation? So sticking with the Wi-Fi Interactive here, I want to pull up crude oil. Let's do a year-to-date chart, and we can pull up some candlesticks and really see that it is finally just barely broken the upside. It broke this trading range that had been in all year long, but really when you take a look at the 1 year, that explains some of the drop because we're still down 8.84% year over year in WTI crude. Not as much as we were at the March and May lows here, but we are nevertheless still down. But you'll notice over the last couple of months, ticking up. So on the year over year basis, still looking good. But the concern is that on month over month, we're ticking back up again. I can show you something pretty similar for the S&P, for the Goldman Sachs Commodity Index. Here we have, looking back 1 year, we are up against this 600 resistance level, but we have accelerated to the upside over this last 2-month period. Similar theme here. And then I want to take a look at natural gas. You can see natural gas down 65% or so year over year, but let's take a look at the year-to-date figures. You can see ever so slightly getting back up to that 3% or that $3 level, and that was actually reached and peaked in early March. So if we head above these current levels, it's pretty much a race to the top here. We've seen natural gas inflation, natural gas prices react very quickly to changes in the weather, not so much the macro environment, but it is a very volatile commodity, and we need to respect the fact that it is up substantially itself over the last 2 months. So going back to the original case here, a lot of these subcomponents just moving the wrong direction on a month-over-month basis.
Thanks a lot, Jared. We're going to keep watching them and hoping that they keep going in the right direction, I hope. All right, thanks so much. Campbell Soup announced the acquisition of Rao's Italian sauce owner Sovos Brands earlier this week. Yahoo Finance executive editor Brian Sozzi sat down with Campbell Soup CEO Mark Klaus to discuss the acquisition, the anatomy of a tomato sauce. I'm looking forward to that, inflation, and more.
I think we've been pretty clear strategically that what we really believe has been the power of the transformation at Campbell has been focus. And as we think about focus, what we've been building is this very, very clear, one geography, 2 divisions, 13 categories, of which sauces is a big part of those 13 categories. And as we look at the opportunities to add value and continue to strengthen, especially that meals and beverage portfolio, this ultra distinctive Italian sauce area has been just a significant source for growth and clearly a place where we don't play. And so adding that into the strategy is not a deviation, it's not a departure, it's really about stepping on the gas and just going forward with it. And that's why this was so, I think, such a great fit for us strategically. Why the price? I think, we've been very, very diligent, as I would think people would expect. And we really spent a lot of time trying to understand runway going forward. That's the big part of this deal. It's not one that's anchored on having to do 20 things differently or fix this or fix that. It's really about that runway going forward. And as we look at these businesses, the combination of first just inherent distribution expansion, where I think our commercial operations will be a great support to the great foundation that Sovos has built. Household penetration and awareness on this brand, although impressive where it is, there's still a pretty wide range between Rao's, where Rao's is, and where traditional premium brands are. And that's really in our wheelhouse. Building awareness and driving household penetration is something that we understand really well and are excited about. And then finally, I've said this a couple times, a lot of times when you get into these, people will get excited about a brand and start expanding it into 50 different areas, all with no profit. These guys have been very, very thoughtful and very consistent in expanding into categories where the equity of Rao's is powerful and the underlying profitability or the business models in place. And those are just getting started. So when you think about frozen, dry pasta, soup, all of these frozen pizza, these are all areas where we see just a tremendous runway ahead. And that's why we felt great about the value and where we landed.
Mark, I'm never amazed by the questions that come up after a company makes a big deal. One question I saw there on social media, Campbell Soup, they're going to change the recipe of the pasta sauce. They're going to dumb it down. They're going to make it less flavorful. Can you address those concerns?
Yeah, look, head on, right? We will not touch the sauce, right? We just spent a pretty significant amount of money to buy something that we believe is really, really special. And I can tell you, Brian, I was on the ground in Italy. We have a tremendous partner that is, somewhere between industrial genius and, artisan specialist in building this incredible, unique sauce. And so I want everybody, please, I appreciate all the encouragement in social media, but we are not going to change it. And look, if we want a little bit of proof point, we've been pretty consistent for 125 years with a pretty darn good chicken noodle soup that we guard with our lives to make sure that quality stays the same. So please, everybody, feel good. We're gonna protect that as we should.
Well, I can back that up. As a consumer of chicken noodle soup for about 40 years, it sure tastes the same to me as when I was eating it. But Mark, you mentioned the product pipeline for Rao's. What does that roadmap look like over the next 18 months? Is this a brand where I'm going to walk down the frozen section, I see frozen pizza, but you know what? I see Rao's garlic knots made by the folks over at Campbell Soup.
Yeah. Well, look, I think the first thing I would just say is that the Sovos team, as I said, has done a masterful job building out a pipeline. It was really one of the things that as we got into the diligence that we really were excited about and felt great. And that's really evident across all the segments that they're currently in. So I think you're going to see some pretty exciting expansion within the sauce area. As I mentioned over the last couple of days, they've got 5 SKUs right now in sauces that are at what I would call more critical mass distribution, over 80% of the ACV. The drop off from the next 5 and beyond is significantly lower. And so there's a real opportunity to build out this grocery destination for what is clearly this fast growing, ultra distinctive area that is something that we feel really good about. In frozen, I also think that that team just getting started and a lot of runway ahead. I will say, though, we do have a pretty unique and pretty capable frozen team that's working on desserts and bread. And, who knows what the future could hold as it relates to a frozen tiramisu or I don't know about cannoli. That could be a tough one, but you know what?
Not a tough one for me. Sign me up for that. I got it.
We got a lot of wood to chop already with the pipeline that's in place. But yeah, we're very excited about what this brand is going to be capable to do to extend into some other adjacencies.
Lastly, Mark, before we let you go, a lot of focus in markets on the consumer price index. We're finally starting to see prices come down. Your company has or touched a lot of different commodities in that CPI basket. Do you think we're set up for a deflationary environment next year?
I really think that what we're going to see, and I've been pretty consistent on this, is that we're going to start to walk into a period where there's going to be more differentiation between different cost areas, where you may see some recovery in some areas, but we're probably going to still see some headwinds in other areas. And we know in different parts of agriculture, there's different aspects of ingredients. I do think we'll see some relief in and some of the other structural areas. But at the end of the day, we'll be out talking about guidance here shortly, and I don't want to foreshadow any of that. But I think consistent to what I've said the last couple quarters, this is a world where you're going to have some ups and downs.
Well, that was Campbell CEO Mark Klaus with our Brian Sozzi talking about the recent acquisition of Sovos Brands. We got much more markets action coming up. Stay tuned. You're watching Yahoo Finance. What is your favorite chart or indicator that you're watching right now?
Well, I think I'm watching jobless claims. This is something that is very immediate, and this is something that is really a good real-time indicator of what is happening in the labor market, and the labor market is what we need to really focus on. As inflation is declining, the Fed will be watching the labor market much more closely.
So we found out again today that price pressures are moderating, but is it still too soon to declare victory on inflation? That's been the line from the San Francisco Fed's Mary Daly in recent weeks. Does she still think another hike is needed this year? We'll ask her at 11 a.m. in an exclusive conversation with our Jennifer Schonberger that you don't want to miss.
We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. It's almost 10 a.m.
How worried should people be about the Fitch downgrade, or how should people be thinking about it?
Well, you and I should be worried about it by the time we retire, I think. But it's not an immediate concern. I think it's gonna come and hit us at some point. It's not an immediate problem for the next 3 months, I would say.
It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We're about 30 minutes into trading here on this Thursday. Let's take a look at how stocks are moving this morning. We are higher across the board with the S&P 500, that pointing higher by about 1.3% after July's CPI print showed inflation continuing to moderate. Monthly prices, they were up 0.2% from the previous month, in line with June's increase. Headline inflation rose 3.2% over last year.
And in terms of individual stocks are watching, shares of Yeti up 19% after it reported second quarter results. The company saw a beat on profit, but it saw sales decline by 4%. The outdoor and recreation products manufacturer did raise its full year outlook, and it also provided a crucial update on its product recall. The CEO saying they expect return to double-digit growth in the fourth quarter.
Also looking at Sonos, which beat estimates on both the top and bottom lines this morning. Music to investors' ears, perhaps. It saw revenue rise 0.4%. The electronics maker also revised its outlook for its fiscal year. The CEO, Patrick Spence, saying while they have not yet seen conditions in our categories return to normal, the company can still emerge in a position of strength from the quarter.
And our eyes also on Hanes Brands, and so too are those of activist investors. They are pushing the underwear company to make changes to its board and potentially find a new CEO. Hanes Brands, meantime, just released second quarter earnings, reporting a loss of $22.5 million US. The shares down some 2%.
All right, put Michael Jordan in the game. Disney reported mixed results for its third quarter after the bell on Wednesday, missing expectations for revenue but beating on earnings per share. Disney stock higher today after initially dipping in after-hours trading. Joining us now, we've got Matthew Thornton, who is the Truist Securities Analyst. Matthew, great to have you here with us this morning. How should investors look at Disney stock after this report?
Look, I think we got some positive incremental takeaways here. I mean, the focus for this company right now is clearly profit and cash flow over revenue and subscriber growth, at least for the short term. And if you look at what we got yesterday in the streaming business, profit was better, particularly on pricing. Subs were weaker, but I think that should be and probably was expected. The linear TV business continues to struggle from a secular perspective, but again, I don't think that's new. The box office remains challenging and lumpy. Again, I don't think that's new. And in the parks businesses, look, I think you've got some puts and takes. International strong, domestic softening from really, really tough comparisons year over year. But I think the probably more important incrementals here are, the company talked about raising price in the streaming business probably a little more aggressively than folks expected. They talked about cracking down on password sharing, very similar to what Netflix has done. They introduced a new sports betting partnership yesterday, and they said that their cost actions are actually running ahead of plan. So they're going to do better than that $5.5 billion. So I think if you kind of wrap that all up, profit numbers are probably stable to maybe even rising coming out of this earnings results.
I want to focus in, Matthew, it's Julie here, on the streaming business in particular. And you mentioned that they're sort of following the heels of Netflix here in terms of talking about password sharing crackdown, although it sounds like they haven't done it quite yet, raising pricing, offering more tiers. It sort of feels like after Netflix lost its mojo, it feels like it's gotten it back and then some. And that now there's sort of an also-ran situation where the other streamers are maybe running to catch up with Netflix at this point. Is that your impression, and are they going to be able to catch up?
I think it's a maturation of the streaming market. I think we've had the last 4 or 5 years of pure focus on subscriber growth and gaining scale. And I think we are now getting to a point where penetration rates are higher, where there's a much more balanced approach to monetization and profitability. And so I think a lot of these services, Disney included, are really thinking through what are the right price points, what is the right tiering structure, how do we lay in advertising in an accretive way, because subscriber growth isn't going to be at the levels that we've seen in prior years because the law of large numbers are starting to set in here. So I think it's a very natural maturation process across the streaming landscape.
And so this is still a company as well that has a lot of kind of changeover that's taking place at this time, either in strategy that's enacted or just in terms of what the experience for a myriad of consumers that they deal with looks like as well. But what's caught investors' attention is whether or not there could be parts of this company that are eventually sold off. Do you see that coming to fruition? Is there anything that you heard on the call that gives you the inclination to believe that we could be looking at a far different Disney, or part of a Disney that gets sold off to some other company over the next, say, 12 months to 18 months?
I think what's pretty clear here is there's a lot of optionality, and I think CEO Bob Iger made that point pretty clear. If you look at kind of what the core is of this company, it really is their tried and true owned and operated brands. So the Disney brands, the Marvel brands, the Star Wars brands, the Pixar brands, which of course extend to their portfolio of parks and cruises and experiences. That is the core of this company. That is the growth driver. That is the highest margin, highest value piece of this company. I think where the optionality really lies is around their linear networks business and, of course, ESPN and the sports ecosystem. I think they were pretty clear of that within ESPN. They are preparing for a transition to a streaming world. They are looking at strategic partners that can help them on the content or distribution side. And so what I think that tells you is they are hard at work, pen and paper, trying to figure out where they want to take this business. And it could look very different. And when you think about the legacy networks business, so if you think about ABC and FX and some of the linear channels, I think, again, all cards are on the table here, and that could include a sale or spinoff of those assets. So I think the point here, we don't want to get over our skis, but the point here is there's a lot of optionality, a lot of work being done, a lot of conversations being had.
Matthew, bottom line, I know you're a buy on the stock, but given what we heard specifically from the company on the call and in the report, would you be buying that stock today on what you heard?
Look, I think the setup here for the stock is better today than it was yesterday. And then the reason I say that is, again, I think the results that we saw yesterday were better than feared. I think profit numbers are probably stable to going up coming out of this print. We have an investor day, a 3-day investor event that they'll host next month where we'll get more incremental color. And I think sentiment in general, could swing in a couple different areas. If you think about the ongoing strikes, I think sentiment is clearly, pinned negative there. If you think about box office choppiness, those are things that can go back the other way pretty quickly. So we actually think the setup today is better than it was 24 hours ago.
And then just one quick final question on the parks, and specifically on Disney World in Florida. What's going on there? Like, what's really going on there? And are we going to see a rebound in the traffic there?
I think it's a combination of several things. I think you've got really tough comparables. Remember, they had their 50th anniversary promotions and events last year. You're starting to anniversary those. I think, when you think about 2022 into 2023, I think there was a lot of catch-up vacationing because of what happened during the pandemic, and that's starting to moderate and normalize here. And so I think it's a law of large numbers and a lot of normalizing of demand and tough comparables that you're seeing in Walt Disney World. I think conversely, if you look at perhaps Disneyland, but certainly more so international parks where the pandemic's extended a little bit longer, so we're still much earlier in that catch-up phase. Those are still outperforming and exceeding expectations. Cruise lines are another great example there. So I think they're in different parts of the curve, getting back to kind of a normalization.
Thanks so much, Matthew Thornton, Truist Securities analyst. We want to zero a little bit more in here on that question of whether Disney could be a buyout target. It's a big question coming out of the media giant's third quarter earnings. You apparently shouldn't ask CEO Bob Iger specifically about it. Here's what he had to say when asked on last night's earnings call.
On the theme of considering options for Disney, there was an article published recently that speculated that the entire company could be sold.
I just am not going to speculate about the potential for Disney to be acquired by any company, whether they're a technology company or not. Obviously, anyone who wanted to speculate about such things would have to immediately consider the global regulatory environment. I'll say no more than that. It's not something that we obsess about.
Iger may not be obsessing over it, but some analysts probably are. Joining us now, Robbie Whalen, Wall Street Journal reporter who covers Disney. Robbie, maybe they're not selling the whole company, but there is still the question of parts of the company, what will be sold, and I think that's still very much on investors' minds. What are you hearing from inside the company and from investors and analysts about that question?
About the sale of assets, you mean?
Yes.
I'm hearing that Bob Iger is very anxious to reduce his exposure to the linear TV business, which not only is dying a fairly quick, painful death, but it also is something that he's been talking about for over a year. I mean, he has his famous quote from when he was not in the CEO's chair last year, where he said that linear TV is headed for a precipice, and we don't know. It's not a matter of if, but when this business stops being profitable. A lot of people think that once we hit 50 million U.S. households with access to cable packages, either through traditional cable or these digital services that bundle cable channels, that's sort of a psychological barrier, and there's a lot of people who are kind of going to drop out of the business at that point because it's going to be much harder to make money. But yeah, I mean, he clearly wants to sell whatever value there is left in that business. He's made it pretty clear there's a for sale sign on that. And he's looking for partners in ESPN. From what I've heard from folks who speak to Iger is basically that he wants to reduce exposure on linear very badly. He wants to get that done as soon as possible because it's a big albatross on the company's stock price. But also that he feels very strongly that ESPN needs to continue to be part of Disney going forward. And to the extent there have been rumors that ESPN might be spun off or is on the block itself, I've heard those rumors kind of, diminish by people who know what's going on.
Interesting. So, if indeed, as you're talking about, he's been wanting to somehow exit or reduce exposure to the linear business, why hasn't, ESPN aside, is it tough to find buyers for this stuff right now because nobody wants exposure or more exposure to this business?
There's some thinking that TV networks like that could sort of go the way of newspapers, the way they've gone in the last few years, which is to say that there might be buyout firm interest from them. Certainly, there's interest at a fire sale price in them. But I mean, don't forget that these networks and this business itself, for Disney at least, still throws off about $1.8 million, $1.9 million a quarter in operating income. So it's not like they're actually losing money on this business. It's just that there's been this inflection point we've reached at Disney at least, which is that businesses like the parks are really a lot more reliable at this point than linear TV. For years and years, linear TV is what subsidized every experiment that Disney wanted to try. It's certainly what subsidized the push into streaming and sort of the all-out push that they made at the very beginning, where they were focused entirely on growth and on attracting new subscribers and basically giving it away for free to a certain extent. That was all paid for by these advertising fees and subscription fees that the linear TV business generated. They're just not coming in as consistently anymore, not by a long shot.
Robbie, what's clear here, too, is that there have been two very different types of eras that Bob Iger has had to govern Disney through. And previously, it was the one where they were acquiring some of the major kind of content producers and then also making specific deals in order to make sure that they could grow out their business and kind of engage with a larger fan base. And now in this one, it seems like we're watching kind of an executional strategy where trimming some of the costs, some of the fat, trying to figure out exactly where that next wave of growth or leg of growth is going to come from, and ultimately what the succession plan looks like at Disney. But for right now, with Bob Iger over top of the company still, what is the defining type of narrative that kind of annexes itself to his leadership right now through this era?
Well, yeah, it's a really strange thing to see in a lot of ways. Bob Iger as seller, and as you noted, for most of his career and for most of his time leading Disney, his legacy and his the imprimatur that he's put on the company has been to acquire. He's bought Pixar, he's bought Marvel, Lucasfilm, and then of course the 2019 deal to buy most of the entertainment assets of Fox. That was a $72 billion deal. This is a guy who's made being acquisitive his signature for the Walt Disney Company. And he's had great success. He's grown the company from, something like 40 billion market cap to, at one point it was around 270 billion market cap. I mean, the growth has just been phenomenal, and that's why he has the reputation that he has. So looking at him and seeing him saying, our new MO is we're going to sell in order to right the ship and to stabilize the company for the future is jarring for a lot of people. And I think it's actually jarring even for him. I think if he had his druthers, he would be out there thinking about what's the next company, the next library of IP that he can acquire to sort of lead the company into the future. And to be clear, there is one acquisition that he's looking at, which is buying the rest of Hulu from Comcast. I mean, Disney's going to be locked in a negotiation with Comcast over the next year, likely to sort of figure out what the right price is for the rest of Hulu. But I think it's very uncomfortable, and I think it's going to be really interesting to watch how that plays out on succession. Because if you're a guy whose core competency is growing and acquiring and expanding a company, a beloved American brand, into other areas and other storylines, other types of content, when that's what he loves to do, if what he's being forced to do is instead to sell off key assets, including ABC, where he essentially grew up as an executive, you can see how that might wear on somebody and how it might not seem like he's having a ton of fun, because that's what he has to do. He's making these tough, painful decisions.
Well, Robbie, he doesn't have to do the job forever, as we well know. And as you've covered, succession is the other big sort of question hanging over the company. Just quickly here, a little confusing that he's brought in Tom Staggs and Kevin Mayer as sort of advisors now. But what's the latest we need to know about succession?
Yeah, that sort of set off the rumor mill running in a reasonable way, I think. I mean, so Tom Staggs, former CFO, former Parks head, a lot of experience in operations. Kevin Mayer is more of a deals guy, but he was definitely Bob Iger's right hand on deal making and growth when he was at the company. And the really curious thing here is that those guys now have moved on pretty fully. They're investing a few $1 billion for Blackstone in their own company, Candle Media, acquiring some brands like Reese Witherspoon's Hello Sunshine, Coco Melon, a lot of brands that might be of interest to Disney. But I have a hard time seeing Disney. In other words, Disney would have to buy them out most likely in order to bring them back if wanted one of those two guys to become the next CEO of Disney. And it's sort of every day that goes by, it sort of has felt less likely that might happen, just given the financial shape that Disney's in. I mean, you have to buy out a very big company in order to sort of pry away its leaders. And then secondly, Iger, you have to keep in mind, these two guys are guys who Iger passed over before. He elevated them to roles that really seemed like they're being groomed to be the next successor of the company. And he decided, no, I'm going to go somebody else. He went with Bob Chapek. And so it's very curious to see them back in the fold, even in advisory roles. But it's definitely set the rumor mill running. I think on succession, look, the guy just signed a 2-year extension on his contract. He'll be here ostensibly until 2026. We know that they're looking at people, but I just don't think they're there yet. I mean, I don't think I think he really wants to do this right this time, and right means find somebody who can execute on his strategy and carry the company into the next era, so to speak, competently. And he wants to avoid what he views as kind of a nightmare with the last time he did this. And I don't think we're that close to having an answer on that yet.
Yeah, well, hopefully he won't wait until, right before his contract is up. Robbie Whalen, thank you so much for your perspective on this. So the Wall Street Journal reporter who covers Disney, appreciate it.
Thanks.
We got much more markets action ahead. Stay tuned. You're watching Yahoo Finance.
When you think about the bellwethers that we've seen over the course of this earnings season, is there one that kind of takes the cake?
I think that in large cap tech, things have been fairly mixed. There's been some good and there's been some bad. The growth trade is fighting back, trying to keep leadership, but the value trade is putting up a pretty valiant effort to take it over, and the growth stocks haven't made it easy.
Let's do a check of the markets nearly an hour into regular trading, sponsored by Tasty Trade here in stocks at the highs of the session. The Nasdaq gaining by 1.4%. The Dow and the S&P each up about 1.1% here as we see stocks climb in the wake of that CPI report that came in line with estimates. We've got consumer discretionary stocks gaining the most today. The XLY up about 1.7%, followed by big tech, communication services, and infotech, both rising as well. Well, this morning, Tapestry, the owner of Coach, Kate Spade, and Stuart Weitzman, announced it would be acquiring Capri Holdings. That's another global luxury fashion company that owns Versace, Jimmy Choo, and Michael Kors, bringing 6 brands together. The two companies, when combined, see sales of over $12 billion and locations in over 75 countries. This news is riding the tailwinds of CPI data released this morning as well. Apparel saw no change from the prior month in price, but it has risen 3.2% year over year. So let's talk about the state of retail and this deal specifically with BMO Capital Markets retail and services analyst Simeon Siegel. Simeon, it's great to see you. I was texting you this morning and I called it sort of like baby LVMH that they're trying to put together here. What does bringing these brands under one umbrella do for Tapestry?
I'm sure they love that phrase, by the way, Julie. That's probably the cherry on the top. Good to see you. So I think that, I think there's no question. I think we're watching certain pieces of luxury businesses being grown. We keep hearing about the European conglomerates left and right. And I think maybe with the U.S. side doesn't get as much credit. And so this does, on the one hand, feel like both Tapestry's way of taking advantage of depressed multiples in general across the space, and then also buying their way into cash-generating Michael Kors, and then luxury businesses, Jimmy Choo and Versace. So it's an interesting diversification, and I think it is an attempt now at expanding the scale and creating a version of the U.S., the same European powerhouses.
Simeon, I continue to read about this new age of quiet luxury, if you will, and I can't help but wonder, for those who find themselves as power purchasers within the luxury market, what this does, what this combination looks like for these two companies, how they benefit even in that age of quiet luxury that we've continued to hear about from analysts and some investors out there.
Yeah, it's an excellent question. I was waiting to see your logoless cashmere hat. But I think at the end of the day, not every part of luxury is quiet. And we know that. I mean, logos will always have a place. And generally speaking, when you're referring to quiet luxury, it's also a different scale. So I think right now, the sheer revenue size, that beautiful PDF that we had over there showing the 12 billion revenues, argues that these are very real businesses with very real customer resonance. I think you're absolutely right. This quiet luxury has become a nice buzzword, and it has implications for how far to take logo and for how much you can raise your price with flashy logo. But I think that when you look at that revenue base of Michael Kors and Coach, and you see who they are selling to, there is still a strong desire for that product.
I'm curious about the price that they're paying here. Now, by my math, it was about a 65% premium to yesterday's close. But to your point here, the valuations have been depressed. So how should we think about how much Tapestry is paying up for Capri?
Yeah, it's funny. It's actually below. I mean, you and I have talked about Capri for a while. It's actually below my price target. Not that my price target should mean a lot, but I think exactly your point. When you think about what's happened across retail, we went from 2008 to 2020. Retail is supposedly dead. In 3 months at the end of 2020, because of inventory scarcity, retail was absolutely back and party like it's 06. And then the last year, we've gone back to retail's dead. None of those extremes were actually true. But I think what it created was this opportunity for Tapestry to look at one of their primary competitors and adjacent companies and take advantage with a premium that was really nice relative to the close yesterday, but all things considered, still not at peak. And so I think that's a very important point, and it's probably an important point for the rest of the sector.
Do you think there's going to be any massive restructuring to how the storefronts are laid out? Because, I mean, these are brands that everybody knows, but as standalones, they've always been accustomed to having their own storefronts. And so now that they all roll up into one, and it's not necessarily that Tapestry has combined even the brands that they did acquire and create under one umbrella company. So is there any change in strategy that you expect?
I think it's interesting. When you look at the Gap portfolio of brands, you see a website that shows you all three. The consumer generally knows they're owned by the same. When you take Julie's adult version of Tapestry, the European luxury houses, most people don't necessarily. The consumer doesn't associate them as being one parent. I think it's probably going to be more of the latter. I think the synergies are back office. I think the synergies are recognizing there's two corporate offices, more so than, and again, I don't know, but more so than what I would assume will all of a sudden become side-by-side locations saying walk into either Coach or Michael Kors. So I think that keeping the brands, letting them have their own distinct identities is probably critical. I think it's a really good question, but I would, at least from my seat, I would assume the synergies are more going to be back office. I think if they blend the brands, they end up diluting the brands.
Samin, let's take a step back and talk about the state of luxury here, or at least high end, right? Ralph Lauren also reported today, by the way, came out with some muted guidance. Capri, which was supposed to report, now is apparently releasing its earnings after the close today. Tapestry reports next week. What does that picture look like?
So it's interesting. I was looking at this right before I joined. The majority of the consumer discretionary companies that have reported so far have seen gross margin go up, have seen revenues grow by low single digits. All things considered, that's a really good report, right? We haven't been able to say that in a long time. Part of that is because we're lapping supply chain issues. So part of that is the benefits to gross margin that you're seeing from commodity and logistics. But all things considered, consistency, nice, small growth is a lot better than huge ups and downs. On the other hand, the stocks are actually, generally speaking, underperforming the S&P when they report, and that goes back to the sentiment side. So I think the way that I'm thinking about the world right now from a fundamental perspective rather than from a Wall Street perspective is we're actually back to an environment where retailers can run their businesses. Beginning of COVID, there was no supply chain, therefore there was no availability, so it didn't matter how good you were at predicting demand. You were at the whim of whatever product made it through the containers. That's no way to run a business. There's no winners and losers there. And then in the last year, it was the opposite, where everyone had so much excess inventory that it also didn't matter how good you were at predicting demand. You were just overflowed with this product that you had to move. We're back to normal. And again, that's a hard thing to say because what is normal? But we're back to an environment where I think the companies that are really good at understanding their consumer and predicting inventory accordingly will win. Whereas the others will find themselves overflowing with promotions, not because they have excess inventory, not because they have a lot of inventory, but because they have more inventory than their demand. And that was a predictability function. That's comforting, right? That means that the ability to execute, the ability to triumph as a retailer is back in the pocket of management. And we haven't been able to say that for a while.
What would you say is your top pick as we go into the thick of earnings season?
So Capri was one of them. It's probably not a fair thing
that
for me to say
worked out
right
okay.
now. But I think if we think about Capri, I think the reality is it was incredibly cheap. And did I have any idea there was going to be an acquisition? Certainly not. What I looked at was a risk-reward framework. I think if you and I've talked about companies like Bath & Body Works, which are replenishment-driven businesses that are trading very cheap. I think it's too easy just to look at PE normally and say if something is below 10 times in my space and there's some semblance of predictability. But right now, that it's probably a worthwhile endeavor. And it doesn't mean you're going to get these catalysts right away. But I think there's an element of looking at risk reward. I think certain times you want to make sure you have the catalyst coming up and you want to have a general view of what earnings are going to be to the extent you can. Other times you want to say, if my downside's protected, if the company is intrinsically worth more than the market is paying for it now, at some point it will go higher, whether because a public investor comes along and decides it's worth more, or whether a Tapestry comes along. And so I think that's the interesting dynamic here, where we still have Capri, I think, will wake a lot of people up to the fact that perhaps the valuation floor for a lot of these companies should be higher. They still need to perform. They still need to earn it. But there's a lot of companies where valuation simply hasn't mattered and you could just keep going lower. And I think that might at least take a little bit of a reprieve right now.
All right. Going to keep my Versace flip-flops in the cart for right now. Thanks for breaking this down for us. BMO Capital Markets Retail and Services Analyst Simeon Siegel. Great to speak with you this morning.
Good to see you guys.
Thanks. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. This earnings season, has it lived up to expectations?
I think it's been fine, but I think it's been a little bit soft. So I think the problem is we got used to all these positive surprises and coming out feeling really good, and we just haven't had that.
Call it the eternal networking infrastructure battle. Cisco versus Juniper. Whether it comes to routing, cloud support, security, and anything around the Internet of Things, IoT. They're two of the giants of the space. Cisco has long been the biggest name for many, but Juniper has been knocking on the door for some time now. It's also making strides in the AI realm with its Mist platform. Results at the end of last month weren't quite as upbeat as investors would have hoped for. However, its third quarter revenue outlook below estimates on lower spending by cloud clients there. So does it still see itself as the keeper of global network? Big question there. Joining us now, we've got Rami Rahim, who is the Juniper Network CEO. Thank you so much for taking the time here today. First, perhaps you could take us into this outlook here and just the demand environment that you're witnessing right now.
Certainly, yes. So, we are seeing right now, very good outlook for our business for the year. We did have to moderate expectations for our cloud provider business, primarily because of the fact that cloud providers have consumed and purchased an unprecedented volume of products over the last couple of years, and they have to go through this period of digestion to essentially deploy these products. We're very optimistic that eventually the cloud provider business will return. Our Q2 results were great results. We had record enterprise revenue growing at 40% year over year. The enterprise segment is now our largest and fastest growing segment in the business. New logos are growing at 30% year over year or more. And this is primarily driven by our AI innovation and differentiation in the market.
Rami, I guess what I'm trying to understand here, because obviously not just you all have reported, we've had a lot of companies thus far in tech and networking report. In terms of where the spending is, where the willingness to spend is at this point on the part of clients. To your point, the cloud spending has kind of happened, and so we're in a bit of a lull in that area. So where are we in that sort of tech spending cycle overall?
Absolutely. Right now, our enterprise business is seeing incredible results, and the outlook looks very good as well. And we look at this by not just the revenue results that we're posting on a quarter-over-quarter basis, but also just things like order growth, which continues to happen even in the face of very difficult compares to last year. As I mentioned, artificial intelligence is something that we've been investing in and innovating in now for the last 4 years. And we have had a front row seat observing the value that it can bring to consumers, to enterprises around the world. So for example, we're reducing the number of trouble tickets at a global software company by over 90%. We're reducing the number of IT store visits at a global retailer by over 85%. This has resulted in really healthy growth and an outlook for our enterprise business, not just for the rest of this year, but for the years to come.
And you mentioned your AI offering. We mentioned Mist AI. Can you explain to us exactly what that is and how it works?
Absolutely. I actually think we have a clear and defensible leadership in artificial intelligence operations today. What Mist does is that it oversees the entire enterprise network, whether you're a retailer, a healthcare provider, a corporate enterprise, a college campus, and it essentially takes all of the manual labor associated with running this network on a day-to-day basis and moves it to machines, to robots, essentially artificial intelligence, freeing up the time of network operators to do much more useful, much more interesting things like advancing the strategy, innovating, and things of that nature. This is why I believe we're seeing such incredible trends in the enterprise business. I mean, we're in a mode of taking share in the enterprise space as a result of AI, and now this enterprise is our largest and fastest growing business for that reason.
Are you seeing any moderation in the size of enterprise contracts?
Not really. In fact, if you look at the number of large deal, which we measure as sort of $1 million plus deals, that continues to grow at a healthy clip. Our AI-driven campus and branch business in the Q2 period grew at over 100%, or roughly 100% year over year. That includes large contracts and many small long-tail contracts as well.
Rami, thank you so much. Rami Rahim is Juniper Network CEO. Thanks so much for walking us through what's going on with you guys. Appreciate it.
Thank you. My pleasure.
We got much more coming up. You're watching Yahoo Finance.
It's been a wild year in the retail space. Inflation has dominated the headlines, causing shoppers to spend more cautiously.
As a result, profits at major retailers such as Walmart, Target, and others have come under pressure.
Organized crime and a growing list of bankruptcies also continue to cast a shadow over the entire industry.
But what does this all mean for the future of the sector? Should investors dive in or steer clear of retail stocks?
We'll bring you key analysis and hear from some of the biggest names in the industry to answer key questions.
Who is the consumer visiting? What can retailers do to stop the rise in theft? Are more bankruptcies on the horizon? And where does AI fit into it all? It's all part of our week-long special, Retail Evolution, The New Era, starting Monday, August 14th, right here on Yahoo Finance. You won't want to miss it.
We got some economic data this morning showing inflation is continuing to moderate, but grocery prices still saw a slight tick up month over month in July, up 0.3% after a slight decline the month prior. Brooke DePalma is here to break it all down. Brooke, where are we seeing some of the biggest changes in prices and what's causing it?
Yeah, well, good morning, Julie and Brad. I mean, certainly we saw a few months where we saw grocery prices remain flat, and now that's beginning to increase slightly. But the good news here, egg prices continue to decline. We saw egg prices drop 2.2% month over month, down nearly 14% year over year. But the big story here is that while the avian flu outbreak is behind us, what's causing prices to remain high in terms of egg? It's really that corn feed that the producers are feeding the hens, the chickens. It's remaining about $7 a bushel right now. It's expected to go down to $5 a bushel after this harvesting season, but an economist telling Yahoo Finance that will be about 3 to 9 months away. So just hold tight for lower egg prices. Uncooked beef roast also driving prices higher, up 6.5%. Now the beef and veal category was up nearly 2.5%. That was the largest jump in nearly 2 years. What's causing that here is the aftermath of one of the worst droughts that we saw last year that happened in the Southwest, where producers had to sell off their cattle for record prices. That ultimately led to now what we're seeing now, jump in prices as they look to rebuild their stock. We're also seeing fresh whole chickens down 2% month over month. That's the largest decline since September.
of 2020, and actual competition overseas are driving those prices lower as U.S. producers look to match those other markets. Cereal and cereal products continue to be driven higher by producers, by companies really raising prices there. Sugar and sweets ahead of the Halloween season, not looking too hot. We did see a drought impact key sugar beet areas, and it'll take next year, ultimately a year away, in order for those all to recover. But the USDA is projecting that food prices will continue to ultimately decelerate, but not necessarily decline next year. And so buckle up.
What about the cost to eat out?
Yeah, well, the cost to eat out has jumped now over 7% year over year. And what we're seeing is really the impact of higher menu prices drive that. And we noticed more recently in this recent earnings, season, I guess you could call it, is really that foot traffic take a bit of a toll, same-store sales growth take a bit of a toll there. But one economist telling Yahoo Finance that we're not seeing major switches yet, but as consumers continue to be more value conscious, it'll be something to watch out for as they make the decision between going out to eat or going to the grocery store. So once again, Julie, Brad, buckle up. We're in this for the long haul.
Oh, geez. Thanks a lot, Brooke. Well, meantime, is the snack fad here to stay? Hostess brands looking to capitalize on the craze with the launch of new offerings to meet demand. The snack brand's net revenue climbing 3.5% in the second quarter. It also raised its full-year guidance for 2023. Hostess brand CEO Andy Callahan joined us now alongside Yahoo Finance's executive editor Brian Sassi. And it's good to see you here. And I am curious, when you look back at the quarter here, we saw a trend that we've seen a lot of amongst food companies, which is a little bit of weakness in volume and increase in price. How much longer can you try to balance those two before you see a kick up in volume? Andy, we can't hear you. I don't know if it's on your end.
Can you hear me now?
We gotcha. All right. Sorry about that. Go ahead.
No, that was all Andy. But hey, good to be here. Here's where we're at. When we saw real hyperinflation last year, we took aggressive action, as most food companies did, to protect our margins. We have not had passed on a price increase to our customers since about July of last year. So our team's done a nice job of holding that. We're going to be lapping all of those prices. We want to meet consumers where they are in the back half. And we believe we're in a good position as we lap all of the prices, try to hold it steady, deliver value to our consumers in the back half, and see volume recover as we do things like family packs that provide more value to consumers, and use our productivity initiatives to hold pricings where they are. So it's certainly coming out of a spot. Our consumers are certainly feeling the punch, but we believe we're focused on that. We're focused on delivering that value to our customers, ultimately to our consumers, and expect to see that volume recover as our price impact inflation to the customer really goes to back down to normal levels.
Andy, it's Brian here. Always great to get some time with you. I'm going to refrain from asking you if you've seen a pickup in your convenience store business with all these big lottery jackpots, but I will ask you this. Have you seen any impact to the convenience store business lately as gas prices have been back on the rise this summer?
It's a summer season, so we do see traffic more recently, with the rise of fuel, that sometimes has an impact on our consumers' behavior. And a lot of times it increased the frequency to the store because they're not filling up the tank every single time. What we're seeing right now is a slight increase of traffic. We're about flat year on year. That was slightly down in Q2. We expect it to continue to rise, and we're well positioned for that business. Brian, as you know, we have a terrific C-store business. Scott and the team do a great job. We have availability that's about 20 to 25 points greater than our next closest competitor. We're bringing them innovation. So I feel like we're in a good spot for convenience, but certainly we watch those fuel prices very, very tightly.
Something that we've been keeping a close eye on within the consumer price index readings that we get monthly is this food at home figure. And that increased by about 0.3% over the month here. And the reason that we're keeping an eye on that is because that directly correlates as well to your business. If people are going through one less aisle and saying to themselves, you know what, I need to cut back on that particular part of my grocery experience. How do you make sure that you're retaining that customer? And is there any pickup in those grocery aisles among some of the newer products that you've introduced into the stores?
Yeah, a couple of questions there. The first is we partner with our customers to really, throughout the store. We have many points of interruption throughout the store. It's not just the aisle. You are right about the number of units in the basket to offset the price, but we're in a very accessible snack. And as I said before, we try to give our customers the right value. We feel like we're set it back to school. We sharpen value where we think we can. We launch value family packs, which are doing very well, which allow consumers to really participate in larger sizes, but a better value. So we do all of that and partner with our customers in a very good way to be able to take advantage of that. Related to our new items, they are really doing well. And that's one of the reasons why protecting our margins, but doing it not just through price, but through productivity, which our team's been able to do, is really important. It allows us to bring what consumers want. Our new Casbars offering is really off to a terrific start. It's a reimagined baked goods in a bar form that expands the consideration set into the $65 billion snacking universe for all of our consumers and gives them really the quality of baked goods they expect for Hostess, but the indulgence of a bar and layers that they want. So these things like family packs and old-fashioned donuts and our zero sugar Bortman cookies are all ideas that we're able to bring to consumers because of our productivity initiatives. And that's what consumers are looking for in indulgent snacks.
Andy, earlier on today, I caught up with Campbell Soup CEO Mark Klaus, and I see a lot of similarities between how he leads, how you have led. I see similarities in the businesses. You have both led turnarounds of these storied brands. He just made a big acquisition. I mean, do you think there's a deal to be had out there over the next few months as we might start to see a pickup in consumer packaged food? Is there a new category you want to get in? In Mark's case, he's expanding into higher priced pasta sauce.
Yeah, Mark's a terrific leader. I've known him for over 25 years, despite being a West Point guy and I'm an Annapolis guy. He's a terrific leader, so I'm not surprised his success. He's leading Campbell's too. But very similarly, we look at the M&A landscape, and our frame of reference is around snacking and indulgent snacking. And we have built over the last several years capabilities, whether it's consumer insights, marketing and innovation, our supply chain, to be able to take advantage of this growing $65 billion landscape. And we see that M&A and some of these businesses that are maturing are at the right spot that may have been interrupted by COVID, really moving into that space in a really nice way. So it's always part of our calculus. Our number one place for capital is our core business, and number two is M&A. And our team's doing a really nice job of doing that. We're coming out of building out our Arkadelphia bakery, which expands capacity we need. And our next priority is M&A. We think we're in a really good job for that. And if not, our organic growth and our long-term algorithm will create great shareholder value.
Well, the Traeger Grill's CEO once told us that Americans love grilling. And Andy, you've made a good case for Americans loving snacks today. Hostess Brand CEO Andy Callahan and Yahoo Finance's executive editor Brian Sozzi. Thanks so much for the time.
Always great to be here.
Likewise. All right, all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Inflation data out this morning showed housing costs accounted for 90% of the monthly increase in consumer prices, with the cost of shelter rising 7.7% over last year. The cost of rent rose even more over the last year, climbing 8% in July. Yahoo Finance's Miles Udland and Yahoo Finance's 2023 All-Star Summer Intern, Jared Midovich, who spearheaded our chart book project, joins us now to discuss his favorite chart from the 50 that were submitted by some of the top voices on Wall Street. Which one major kind of top spot here?
Tough question. It's good to be here. I mean, there's so many to pick from, but the one that really caught my eye was Andrew Hunter's chart about what's called the new tenant repeat rent index. So that's basically a lot of what we're talking about today, right? How rent accounted for 90% of the CPI increase in July. And in this chart, you can see that a certain index advanced by 9 months shows that rent could actually finally be turning the corner and coming down. And I have to say, as a college student, that means a lot to me as someone who's frequently looking for off-campus housing and might be moving into the real world in a few weeks. So that's a chart that definitely caught my eye.
And it's interesting the way that the shelter index is calculated, but they use owner's equivalent rent. So it's what it would cost me and Julie to rent our houses back to ourselves is how they're calculating that. But the index that we kind of flagged there, the one that's advanced, is if I went to go sign a new lease, say I was a renter and I went to go sign a new lease, I probably wouldn't be seeing that kind of increase. And so that's the lagged effect that we're kind of all waiting for. And I think there were 3, 4, maybe 5 charts about rent inflation in the chart play.
Yeah, and this is one of the complaints about the Fed, right, is that they look at that owner's equivalent rent, that it's a lagging number, that it doesn't really capture where rents are going, right?
Yeah, that's basically what Mohamed El-Erian told you.
Yes, that is what you told us.
Yeah,
that's
right.
Because the Fed isn't looking at
Right.
this chart that you guys are highlighting.
Exactly, yeah.
Not yet.
Not yet. Maybe they will.
Maybe they will. I mean,
Did the other housing charts that you guys had in the chart book show sort of similar trends that things are going to get a bit better?
Yeah, I think so. A lot of the ones that were more about housing inventory kind of showed a more dire picture just in terms of the low number of houses that are available right now. But as Miles mentioned, there were several charts that mentioned the current rent inflation and how it could be turning a corner, which could play into the Fed's calculations going forward.
Well, you've been renting in the great city of Philadelphia, and I say that from a purely biased perspective, but also given the fact that you let us know where you go to college at as well, and I went to school right across the street. So congratulations to you, and thanks for joining us this summer.
Thank you.
Yes, you've been killing it. Jared Midovich, everybody, and Miles Udland. But for today, we're going to give Jared the gold star, right?
Don't show me. Don't show me.
Don't show me. All right, Michelle, I can you for the next hour of trading. Have a great day, everybody.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. So, price pressures are moderating, but is it still too soon to declare victory on inflation? Our own Jennifer Schonberger will have an exclusive conversation with San Francisco Fed President Mary Daly this hour. And Disney's price hikes made headlines, but a political showdown still looms. We'll speak with an expert on the entertainment giant's battle with Florida Governor Ron DeSantis. Plus, it's been a difficult start to the month for shares of Apple, but there's a further correction still to come. We'll also break that down for you coming up this hour. But first, let's check in on the market action. We're seeing all three major indices. A very different story here after that inflation data, that CPI data coming in softer than expected. We see here the Dow here up about more than 270 points off the session highs, but still solidly in the green there, up about 0.7%. The S&P 500 there in similar territory, up about 0.75% or about 33 points. The tech-heavy Nasdaq there, strongest gainer so far this morning, up 117 points or 0.8%. And with that in mind, let's also check in on the Treasury market as we continue to see investors really digest some of this information, as well as so far what we've heard from some of these downgrades. We see the shorter-term 5-year down about 1/3%. That 10-year still holding just barely that line at 4% there, but down about 0.2%. And the longer-term 30-year yield, that's the only one in the green right now, up ever so slightly. Well, July's CPI print shows prices are continuing to moderate, with headline inflation up just 3.2% over last year. So the Fed's fight with prices, is it coming to an end? Well, let's get some crucial perspective now with Yahoo Finance's Jennifer Schonberger. Jennifer?
Thank you, Rochelle, and I want to welcome into the program Mary Daly, president of the San Francisco Federal Reserve. President Daly, it is great to see you. Thank you so much for joining me.
Oh, my pleasure. Great to see you.
So we got this morning's CPI number coming in cooler following the past string of inflation data we've gotten over the past couple of reads. Your take on this morning's number?
So the CPI data came in largely as expected, and that is good news for families and businesses who have been fighting against this high inflation. It's also consistent with what we believe will be happening, which is that inflation will gradually make its way down. But it is not a data point that says victory is ours. There's still more work to do, and the Fed is fully committed to resolutely bringing inflation back down to its 2% target.
Looking ahead, I know you like to focus more on the core number, but we have seen oil prices jump by some 14% over the past month. Do you worry that that could create upward pressure on inflation, just as we're starting to see things ease, see that creep into the core number, and as you're nearing the end of your rate tightening cycle?
Well, I think that's a terrific question, because what I always say is that Americans pay for gas and food. And so while they are volatile and they move around a lot, those are headline numbers that hit people directly in their pocketbooks. Unfortunately, we don't have tools that really work against those. Those are globally traded, and those are going to be volatile. And one of the reasons we're so committed to getting core inflation down to its pre-pandemic levels is because that gives some families buffers, businesses buffers, when energy prices and food prices fluctuate, as they always have. But when you're facing high inflation, above target inflation on everything you purchase, and then you get a big increase in gas or food, well, then that's really distressing to families and businesses as they make their way through this economy. So we don't control gas or energy prices or food prices, but definitely by bringing demand of the economy back in line with supply, we're going to get broader inflation relief. And that's going to be the thing that, I hear it mostly. I have 9 states in the Western United States. I can talk to any single person. I ask them, what's your number one concern about the economy? They still say inflation. More work to do.
Do you take any solace from the past 2 cooler job reports that perhaps supply and demand is coming back into better balance in the labor market and could put downward pressure on inflation?
I see those rebalancing of the labor market as a very necessary part of what we're trying to do. It's also expected as we raise the interest rate, the economy cools. And as the economy cools, then employers need fewer workers and the labor market comes back into balance. there's really this important thing that I think all listeners, as they navigate what's the Fed doing, can be helped to understand, is that we are definitely focusing on how things are, the green shoots, really, the cooling of the economy. But we're also quite mindful that we need about 100,000 jobs per month to keep things steady. We're adding, 200,000 jobs a month. So we're still at levels that are higher than we will expect in the longer run. Same with inflation. Inflation's coming down, but it's still too high. And we really have to think about how does that affect our projections of what inflation in the labor market will look like, say, in 6 months, and then what should we do with policy to make sure that we achieve both our goals, price stability and full employment.
So then, given the latest data, how does that inform your outlook for inflation? And you say there's more work to do. How much more work is there left to do?
Well, that's a question that, I don't have a direct answer to. So what I do know is this, that there's a lot more information coming in between now and our next meeting, and certainly between now and the year. And, I use the word information instead of data because it is, I think, a misnomer. And in fact, I heard the earlier part of your programming that says maybe the Fed looks only at the headline numbers, whether that's on inflation or the labor market or housing prices. We are actually looking deeply within the data and asking questions like, what are new rents doing? What are people feeling when they go out and lease their first property? Or what do my contacts say about, are they going to hire workers next year? Are they cooling off? How much price pressure do people feel when they are out in the marketplace? Those are all the information sets we have. And being data dependent as a Fed means you're taking all of that information in and you're using it to project what we think will happen. And so as I look at that, I see slowing in the economy, but not there yet. And that's what my contacts across the district tell me, whether I'm in, Alaska, Hawaii, California, Idaho, Utah, Arizona, I could keep listing them. I hear the same thing. Yes, the economy is slowing down. It feels less frenzied, but boy, it's still hard to find workers. If you're a worker, it's still hard to afford things, even though you're making good wages. It isn't really quite in balance. And that's the important work that we need to continue to do as a Fed. How we do that, whether we raise another time, hold rate steady for a longer period, those things are yet to be determined. And it would be premature to project what I think would happen because there's a lot of information coming in between now and our next meeting.
I know you just said there's a lot of information coming in. It's premature to project, but going into the last FOMC meeting, you were of the mindset that a couple more rate hikes did make sense. Surely you hiked by 0.25 percentage point 2 weeks ago, leaving perhaps one more rate hike on the table. Do you still feel that one more rate hike is on the table at this point?
So, I think this is a really important thing to highlight. Back in June, the FOMC, as it does 4 times a year, put out the summary of economic projections. And then the summary of economic projections in June, we'll have another one in September, but in June, the median of that summary of projections was that 2 more rate hikes would be required to really bring policy rate up to its peak rate before we would hold it. And then what we've been doing since, and I would be one of those, as you referenced, been watching the data and asking, does anything we're seeing change the outlook? So I have another projection I'll need to write down in September, and I'm watching the very data you talked about. But again, the inflation data right now, this is just a good data point. It says that data point is in the right direction. But as you yourself mentioned, oil prices are volatile. They can rise. We could get, if core services ex housing stalls out and doesn't continue to come down, that would be information. I'm listening to my contacts. They're telling me inflation's too high and they're worried about reacceleration in some areas of housing. These are all things that make my decision for me. So that's why I'm going to hold myself to this. Data dependence. I was very supportive of the rate hike we took, and I'm very supportive of not prematurely projecting what we'll be doing. There's a lot of time between now and September when I have to write down another projection, a lot more information coming in.
So then what would you need to see that would make you feel comfortable moving to an extended hold?
What I would need to see is a continued, really gaining confidence that the path of inflation is completely downward, right? And that is really not food or energy prices, because those are, as we talked about, volatile. It really is in goods price inflation, which seems to be on that path. It just keeps coming down. Housing price inflation or shelter price inflation, which is absolutely something we project will be coming down more, as we get through the year, because first it happens to home prices and then it filters through to rents. And if you look at new rents, new leases, you can use a lot of these disaggregated data by geography, and you see that those are pulling this down further. So that is something I expect to happen. The real piece where we're going to be doing a lot more thinking and watching is in this core services without housing included, ex-housing, super core, some people call it. That is a big component of spending for people, and it's something that has really not made much progress so far. Now, that's not surprising, really, because it's less interest rate sensitive, but we do need to see that come back to pre-pandemic levels if we're going to be confident that we can get to 2% on a sustainable basis. And I'm going to need to see some traction in getting there before I feel comfortable that we've done enough.
So if we were to get a couple more inflation reports similar to the past couple we have gotten, would that be enough for you to feel comfortable to stop, or would you need to see more reports than that?
It's not about the number of reports. I can't emphasize enough that the reports are useful, but they're only one piece of information about the inflation picture. I look at a variety of other indicators. I'll give you some elements of my dashboard. So I definitely look at CPI and PCE and the disaggregated, but I also look at the surveys about our firms thinking about raising prices and how much do they think and what sectors are they raising in. The Bureau of Labor Statistics puts out information, not every month or anything, but definitely frequently enough you can get some value from it on the frequency and magnitude of price increases among firms. Those are really telling. And then, of course, we do surveys across the United States, not only ones that are done outside of the Fed, but ones that the Fed does as well. And all of that information, along with conversations with my contacts, tells me this. So if I can accomplish nothing else in our time together today, it's that, yes, we look at the headline releases of CPI and PCE, of course we do, but it's not a sufficient picture. It's a necessary part of the picture, but it's not a sufficient to determine policy. That takes these other activities that we engage in to fully complete the picture. If we didn't do that, we could be almost head faked by data that's largely backwards looking. And we're a data dependent Fed. We don't look backwards only. We look backwards to see what's happened, but we look forward to see what will happen.
Speaking of looking forward, as you eventually look to hold rates at certain levels for some time, as inflation starts to come down, how will you judge whether the policy rate has become too restrictive and eventually needs to be trimmed?
Well, there are really some primary ways you can determine this is by looking at the economy and looking at the labor market, looking at demand for goods and services and seeing if it's back in balance with supply. If it starts to slip under supply, we end up with too much supply, well, then that would be an indication that we can let go of the reins bridling the economy. So it's an assessment, just like we've been making an assessment in the last several quarters about how high should the policy rate go. And that's the assessment we're in right now. We would make the same assessment using the same tools and discussions and techniques and studies to make the assessment, are rates right where they need to be, or do they need to be adjusted as inflation comes down? Are we putting too much restraint on the economy? We are a long way from that kind of conversation. We're right now trying to decide if the policy rate is high enough to be sufficiently restrictive if we held it for some time. But definitely you're bringing up a conversation that I expect we'll be having next year. I just can't tell you the answer to that conversation because a lot of that's going to depend on, the vast majority of that will depend on the economy and the path of inflation.
All right. Well, President Daly, we'll have to leave the conversation there, but thank you so much for your insight. I so appreciate it. Look forward to talking to you again soon.
Me too. Thank you so much.
That's Mary Daly, President of the San Francisco Federal Reserve. Rochelle?
All right, thank you so much. Our very own Jennifer Schonberger there with a fantastic interview with San Francisco Fed President Mary Daly. All right, well, I'm watching shares of AppLovin as they soar today, up over 20% on better than expected second quarter earnings. Now, the software company turned to a profit this quarter, surprising the street with earnings per share of 22 cents, while analysts only expected 8 cents. Now, AppLovin also beats expectations for its third quarter forecast, now expecting to see revenue between $780 million and $800 million. Now, the stock is on fire, tripling so far this year, thanks in part to the AI hype that has been dominating the market and, of course, all of earnings season. All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
It's been a wild year in the retail space. Inflation has dominated the headlines, causing shoppers to spend more cautiously.
As a result, profits at major retailers such as Walmart, Target, and others have come under pressure.
Organized crime and a growing list of bankruptcies also continue to cast a shadow over the entire industry.
But what does this all mean for the future of the sector? Should investors dive in or steer clear of retail stocks?
We'll bring you key analysis and hear from some of the biggest names in the industry to answer key questions.
Who is the consumer visiting? What can retailers do to stop the rise in theft? Are more bankruptcies on the horizon? And where does AI fit into it all? It's all part of our week-long special, Retail Evolution, The New Era, starting Monday, August 14th, right here on Yahoo Finance. You won't want to miss it.
Let's do a check of the market sponsored by Tasty Trade. Still seeing green across the board, although we are seeing some of that buying action starting to slow down as markets digest some of that CPI data. And as we heard from San Francisco Fed President Mary Daly, the Fed's still saying it has some more work to do. The Dow, though, still up about 0.6% or 220 points. The S&P 500, they're also up about 27 points, about 2/3% there. And the tech-heavy Nasdaq, still the strongest gainer so far this morning, up about 0.7% or about 97 points. Well, Apple has seen a brutal August so far as growth fears scare off investors. But is a further correction still to come for the tech giant? Yahoo Finance's Dan Howley joins us now with the details. Hey, Dan.
That's right, Rochelle. Investors are looking at Apple and the results from the previous quarter, the continued drop in overall revenue, as well as the poor performance of the iPhone position. That's basically, the breadwinner for Apple. It's always going to be, at least as far as we've seen. Services did have a good quarter, but moving forward, now the question is, Apple has admitted that there's a slowdown in the smartphone market. Everybody knew that already, but now they're officially coming out and saying it. What does that mean then for this quarter, as well as the next quarter when we get the presumed iPhone 15? Is it going to be enough to start getting people interested in buying up smartphones again? And it's something that I think Apple is going to have to answer to once those phones are revealed in September. They're going to have decent features. Right now it's basically the same rigmarole. New cameras, new processor, basically looks the same. So can Apple really push the envelope enough to get people back into stores, back online, and picking up their products? The same thing has to do, is going on with the iPad and the Mac businesses. Those are both really suffering, though. Those are kind of an industry-wide trend where people bought their PCs or laptops, they bought their tablets during the pandemic, and now they just don't need them. And so we're seeing that from manufacturers to chip makers as well. So, for Apple, it's going to come down to, can they get people more interested in buying their smartphones come the announcement in September?
And a similar situation happening for NVIDIA, a superstar year to date. But what's been happening in August?
Yeah, it's obviously the massive run-up on NVIDIA throughout the year, and now the question is, can they keep that going? They had really bullish projections for the coming announcement that they're going to have from the prior quarter. And so I think people are wondering, are they going to be able to meet that? And then what comes next after that? NVIDIA really is kind of a singular company when it comes to the AI space. They produce chips that nobody else can. They've perfected this over years and years. They made the bet several years ago, and now it's really paying off for them. But what does that mean? I think the other question is, what happens when companies, these kind of hyperscaler companies, go out and begin putting their own chips into their own servers? We know that Microsoft's working on it, Google's working on it, Amazon's working on it. Tesla has their own supercomputer that they're building with their own chips. They already use NVIDIA as well, and Elon Musk had said, look, we'll take as many as we can as fast as NVIDIA can get them to us. But because there's kind of that roadblock, because they're competing with everyone else in the world, we're starting to see companies put out their own chips. So what does that mean then for NVIDIA in the long run as far as these hyperscalers go? And I'm not suggesting that they're going to be massive competition for NVIDIA. It's just potential roadblocks to those different individual businesses that would potentially buy up massive amounts of their server chips.
So something of a sobering effect going on here at the moment as people sort of take stock of some of the players going forward. Great stuff. Thank you for that update, our very own Dan Howley. So, of course, the big story of the day. Here's what we know. Inflation is moderating. The Consumer Price Index rose 3.2% in July over the prior year, a slight acceleration from June's 3% annual increase. Prices were up 0.2% in July from the previous month, in line with June's 0.2% month-over-month increase. But what does this really mean for investors in the later half of 2023? Well, joining us all the way from Austria is Octavio Morenzi, Optimus CEO. Thank you for joining us this morning for us, this afternoon for you. So give us your take here, because when you look at what's been going into the CPI number, especially when you look at the role of energy prices here, what should investors be making of this?
Well, I think what we've seen in terms of CPI coming down over the course of the past few months has basically been driven by lower energy prices, and that's really pushed it down, way, way down. So we've seen the price of gasoline, of heating oil, of diesel, of kerosene, basically everything come down over 20% over the course of the past year. And that has now sort of reached a bottom. So if you look at oil prices over the course of the past 5 or 6 weeks, if you look at natural gas prices, we've seen a big, big uptick there of about 20%. Now that's sort of in the wholesale markets, and that takes some time to filter through into the retail markets, and it takes even longer to filter through and snake its way through the CPI index, but we'll see that happen. So those reversals that we saw in terms of the CPI index coming down, inflation sort of moderating, I fear run the risk now of slowly, gradually over time, as those prices start to get reflected in the CPI, start to inch and creep back up. And that's going to lead the Fed to basically not be able to stop its interest rate hikes. They're going to have to come back to look at this and say they're sort of in a bit of a pause moment right now. They've said they're going to wait a bit, but they're going to have to come back to that, I think, and start to think about raising interest rates again towards the latter part of this year in the next coming months. So that's a bit of a reversal there, and that's going to put some pressure on stock prices, in particular on tech stocks.
And of course, have to talk about the downgrades. Obviously, you've got the Fitch downgrade on US creditworthiness, but then also the Moody's downgrade for some of these regional banks, adding to the situation with creditworthiness and tightening as well. How does that play into the Fed's decision making when you couple that with the CPI data?
Well, Moody's decision to now warn us and downgrade certain regional bank stocks comes a bit late in the game. I think we saw a lot of excitement in that market back in March. And that would have been a good time to basically downgrade, or maybe they could have warned us a bit before that was coming, but they weren't able to foresee that coming. So now they're maybe a bit late to the game. 5 months later, they've decided to actually warn us about some problems in the regional banking market. Fundamentally, nothing's really changed there. So those banks, a lot of them basically sit on very large US Treasury portfolios. Those have come down in price as interest rates have gone up, and that's put some pressure on them. So the thing that has changed is basically the Fed has stepped in with a very generous term lending facility, has basically said to those banks, we'll lend you lots and lots of money, and we'll lend you money against your securities portfolio, even if it's decreased in value. We'll give you the original amount that you paid for it. So that is a very generous sort of backstop, and I think that takes a lot of pressure off the regional banks and some of the larger banks as well. What I did find really interesting in the Moody's downgrades or watch list or warnings about future downgrades was some of the big custodian banks that they put on that list. And by custodian banks, I mean people like Bank of New York Mellon, Northern Trust, and State Street. Those are not sort of household names and bread and butter Main Street banks. They're not really engaged in the business of taking deposits and making loans, but they're basically large custodian banks that process trades and securities transactions for their clients. Now, we don't see any big problem in that sector. They seem to be doing pretty well. 2 of those big 3 banks are growing quite quickly, healthy profit margins. Moody's is seeing something there that we're not. We're not terribly concerned about that sector at all. But we'll wait to see what Moody's comes up with. They're seeing some sort of problem there on the horizon that I think the rest of us have not quite seen yet.
And so then as we look at the latter half of the year here, obviously we have a lot more data prints coming in, a lot more that we'll hear from the Fed between now and then, and being in the thick of earnings season. What are some of your expectations for the latter half of the year?
Well, my expectation for the latter half of the year is that we see the Fed actually revert to increasing interest rates and see continued pressure. I mean, we've seen inflation moderate, but we have a bit of an uptick this time round. I think those upticks might well continue as we see future prints on inflation, and that's going to put pressure on the Fed to carry on increasing interest rates. So I expect to see a couple more rate rises from the Fed at least this year as they look at this data and digest it and basically find that inflation is much, much more stubborn than they had anticipated and is just not going down. So I think that's going to put some pressure on the market then and sort of cap the upside potential at least. I don't expect sort of a big correction over the course of the rest of this year in terms of the markets, but certainly the Fed continuing to increase interest rates, even if it's only moderately, is going to basically put some pressure on the market and not allow it to basically run ahead the way we've seen over the course of the past few months before this month, basically.
And so keeping an eye on that super core in terms of like services for inflation, excluding, of course, energy there. Great having you on, Octavio Morenzi, Optimus CEO. Thank you for joining us this morning.
Thank you.
All right, all your markets action is still ahead, so stay tuned. You're watching Yahoo Finance.
This earnings season, has it lived up to expectations?
I think it's been fine, but I think it's been a little bit soft. So I think the problem is we got used to all these positive surprises and coming out feeling really good, and we just haven't had that.
July's consumer price index showed U.S. inflation continuing to moderate. Monthly prices were up 0.2%. That was in line with June's increase. Headline inflation rose 3.2% over last year. Well, Yahoo Finance's Jared Blickery is here to break down how stocks have been reacting to all this inflation data. Hey, Jared.
Hey, stocks like no surprises. You can see on the left hand of the screen there, all the U.S. indices and also Canada in the green here for about 5 to 0.5% to about 0.7%. Small caps taking up the rear, up about 0.25%. And this is par for the course with the kind of reaction that we've been seeing off the CPI reports this year. Now, I am charting right here, SPY going back, and that's the S&P 500 ETF going back to 2018. That's this light gray line in here. But then the blue line is the stock market reaction in SPY on the days in which we have CPI. I was really surprised to see how much the trends track each other. So you can see going back to 2018, this uptrend matches this uptrend. Then we have a little bit of a retracement. That was actually 20% in the market, so pretty big. We're going up again. We're going down again. Now, when we get to the pandemic, things kind of, I guess I wouldn't say stabilize, but the CPI reaction tends to go sideways in here until we get to the market peak. Now, in 2022, that's when we really started getting hot inflation data that was making which was making Jerome Powell and the Federal Reserve much more reactive and much more hawkish than the market had been pricing in. So not surprisingly, we saw this big downdraft in the market. That was all of last year. And in CPI, we saw it bottom out. But something happened in October with the release of the September data, a huge bullish response there. And the next response in November with the October data was even bigger. So this set us up on the course for this bottom right here being made. That was just a few days after the October release of the September data. So really interesting to see the tight correlation here. If we were to get a surprise to the downside, well, that might indicate a new trend in the S&P 500 as well. So something to think about there. Now, that was kind of the good news. The bad news is I'm seeing a lot of the elements within CPI, especially in energy, they are ticking up again. This is the year-over-year prices in the futures market. And let me just go back here. I want to show you guys another slide. This has to do with the data that we released this morning. Fuel oil on a month-over-month basis, that is up 300 basis points or 3%. On a monthly basis, that is huge. Gasoline, that's up 0.2%, so only 20 basis points, still moving in the wrong direction, which is up. Utilities up 200 basis points. Only electricity moving south in the right direction there. And let's go back to the futures prices because on a year-over-year basis, we're seeing a lot of declines here. Natural gas down 66%, crude oil down materially about 9%, that's CL. From its year-ago price. But you change this over to a 2-month view, you're going to see a reversal. We've seen a lot of these elements pick up. In the upper left, that's heating oil. That's up 34%. Natural gas, 23.8%. Crude oil, 19%. So we're seeing a lot of increases in the monthly numbers here. And so that could mean another reinstallation of an inflation trend to the upside, which is what we don't want to see. So I will be monitoring the energy prices of these inflation reports with a hawk's eye going forward, Rochelle.
We know you will. Thank you for breaking that down for us, our very own Jared Blickery there. Well, Disney's password chain crackdown and price hikes made headlines after its earnings report, but another battle still looms large for the media giant, Florida Governor Ron DeSantis. Richard Fogelsong, Rollins Professor Emeritus and author of Married to the Mouse, Walt Disney World and Orlando, joins us now to break this down. Now, we know going into the earnings call, a lot of investors were wondering what they were going to hear about this. Where do things stand now in this public war of words and the impact it's having when it comes to the Disney parks and the Disney brand?
Well, I'm not sure it has a lot of impact, I have to tell you. You know, when Walt Disney came to Florida in November 1965, gives a press conference, he's asked the question, why are you building a second theme park? And his short answer was because of the darn fickle motion picture industry. And you see that now. Disney, the Magic Kingdom, I should say, the parks have always been the cash cow of the company. That was true way back then, and it's true today as well. We see that in the earnings reports that came out yesterday, where the parks are still profitable, but several of the other ventures of the Disney company are not. The Asia parks are doing better, 90% increase from one term to another. Here in Florida, not so well. The U.S. parks, the one in California and here in Florida, they are both facing a sluggish market. So right there, you can see that maybe Governor DeSantis, for his criticism of Disney, is not having a big impact because the California park, well, it has a friendly governor, friendly to Disney at least. If you look at the tourist markets here in Florida, they're not doing very well either. So that suggests that it's maybe something about Florida. Maybe it's the heat that is the problem. If you look at how Disney's doing versus how the governor of Florida is doing, they're doing a lot better. They seem to know their market better than he does his. He's in this anti-woke crusade, and that doesn't seem to be selling well in the political marketplace. He keeps losing support from one week to another, while Disney's doing better.
Indeed, and I want to talk more about that because we have some sound from the earnings call that I want to play for you and get your reaction. Obviously, you had the big 50th anniversary for Disney, so I just want to get your reaction to this soundbite.
We saw softer performance at Walt Disney World from the prior year, coming off our highly successful 50th anniversary celebration. Also, as post-COVID pent-up demand continues to level off in Florida, local tax data shows evidence of some softening in several major Florida tourism markets. And the strong dollar is expected to continue tamping down international visitation to the state.
So as Bob Iger is saying there, it's something that's sort of seen Florida-wide. So it's not just a Disney story, but sort of this idea of pent-up demand sort of naturally starting to taper up post-COVID. What's your take on that? And were you expecting perhaps this much of a drop-off when it comes to the Disney parks in Florida?
Well, I can see everything that Mr. Iger said. That is, I can see how post-COVID that the market would improve for the Disney company. And I did many interviews over the course of the 50th anniversary, that there were a lot of reasons why people wanted to come to the park then. The Disney company has withdrawn some investment from Florida. In fact, they pulled $1 billion out. They were going to participate in what they called the Lake Nona project, which would involve moving 2,000 workers from California here to Florida. And I think that's something they can continue to do. They had previously announced that over the next decade, they would invest a new $17 billion in the Walt Disney World project. Now they've pulled back on that. So I think there are good business reasons why they're doing that, but that's also a political tool for them to punish Florida, punish Governor DeSantis, you might say, by withdrawing investment from the state. And that's very important because Disney has about an 80% return rate, meaning 80% of the people who come have come before. For that to continue to happen, they need to continue to innovate, new rides, new theme parks, and things of that sort. And really the whole state, the whole tourism industry depends upon Disney reinvesting. We'll see whether that continues to happen.
And especially when you look at the makeup of the board that's now governing this region, there's certain things like even the monorail that goes around Disney, certain things that perhaps Disney didn't anticipate. And when you couple that with some of the movie performances that haven't done as well as Disney would have liked, also feeding into attendance as well, how difficult do you think the path is going forward when you really want better movies, more engaging content coming out, and at the same time you have this political backdrop as well?
Yeah, the content seems to be a problem now. The movies aren't doing very well. The streaming services are not doing well. Those are the new ventures of the Disney company, but we can't forget the cash cow, which is the theme parks, the ones here and the ones in Asia.
Indeed, always been that cash cow, so we'll be keeping track of that. We do appreciate you joining us this morning. Richard Fogelsong, Rollins Professor Emeritus and author of Married to the Mouse, Walt Disney World and Orlando. Thank you for your time this morning.
Thank you.
Well, it's back to school season, and that means parents have their eyes on their wallets for a whole new set of reasons. Inflation is set to hit back-to-back school shoppers. According to a survey from the National Retail Federation, it's expected to hit a record $41.5 billion US. Now, that's up from $36.9 billion US last year and surpasses the previous high in 2021, which was $37.1 billion. Now, the increase in spending is being primarily driven by demand for electronics. 69% of shoppers expect to buy electronics this year, the highest in the survey's history. And of course, to round out the educational experience, back to college spending is anticipated to hit $94 billion US. College students and their families are expected to spend an average of over $1,300 per person. Now, that's a new record from 2021, which saw spending hit $1,200 US and nearly double the cost per person since 2019. All right, well, all your markets action is still ahead. Stay tuned. You're watching Yahoo Finance.
When you think about the bellwethers that we've seen over the course of this earnings season, is there one that kind of takes the cake?
I think that in large cap tech, things have been fairly mixed. There's been some good and there's been some bad. The growth trade is fighting back, trying to keep leadership, but the value trade is putting up a pretty valiant effort to take it over, and the growth stocks haven't made it easy.
This morning, the US CPI report released with inflation hitting 3.2%. Now that's up from last month's 3%. The shelter index and rent index also saw increases over the past month. Let's bring in Yahoo Finance's Danny Romero to break down those numbers for us. Hey, Danny.
Hi there, Rochelle. Well, experts say that these figures show that we're way past peak inflation on the housing front. Let's dive into those July numbers. Shelter costs, which makes up a third of overall CPI, that increased 0.4% on a monthly basis. This was the same in June. Moving on to rent prices, that rose 0.4% month over month, the lowest print since March of last year. Next up, owner's equivalent rent, which measures how much a homeowner would pay to rent an equivalent apartment, that increased 0.5%. And lastly, lodging away fell 0.3%. Overall, shelter costs over the past year have eased. Experts say that housing disinflation will continue to pick up momentum in the coming months. And that also coincides with another study from the San Francisco Fed that says that shelter inflation is set to ease considerably and may even turn negative next year. And these researchers also found that the Fed's tightening campaign has already had its impact. Rochelle?
So Danny, now that this CPI data has come out, how can we use it to understand where rents are going to be headed in the next year or so?
Well, Rochelle, rents are cooling. Rental inflation is easing due to the heavy supply that is hitting the market. But real-time data shows a different story. The rental market still remains under pressure. Zillow reported that nationally, the median asking rent price climbed to over $2,000 in July. Rents are still 3.6% higher than they were a year ago. And some economists say that this could be a blip in the data, not something that we need to be concerned about just yet, because it's still way too early for that increase to factor into CPI, because CPI still hasn't captured the slowdown and rental growth over the past year. Rochelle?
Now, that's the thing with some of these lagging numbers, trying to keep pace of what's actually happening in real time here, especially if you're trying to decide whether or not to rent or go into home ownership. Great stuff there. Thank you so much. Our very own Danny Romero. All right, stay with us. All your markets action just ahead. Stay tuned. You're watching Yahoo Finance.
What is your favorite chart or indicator that you're watching right now?
Well, I think I'm watching jobless claims. This is something that is very immediate, and this is something that is really a good real-time indicator of what is happening in the labor market, and the labor market is what we need to really focus on. As inflation is declining, the Fed will be watching the labor market much more closely.
Earnings season is well underway. The past few weeks have been inundated with numbers from banks, big tech, and a variety of other companies. Wendy's, Penn Entertainment, and Wynn Resorts, along with Disney, of course, all reported earnings yesterday, and the much anticipated big name retailers are going to start rolling out next week, starting with Home Depot on Tuesday. But what can investors take away from results season, and what insights can we garner about the state of the economy? Well, let's bring in Avondale Asset Management founder and editor of the Transcript, Scott Kriseloff, to give us his insights into what we've seen so far. Good to have you on this show here. So talk about some of the key themes that have really stood out to you so far this earnings season.
Yeah, I mean, I think recently we've seen a real rebound in the economy, or stabilization in the economy, at least, alongside the stabilization that's been happening in capital markets, which I think makes sense here. So especially in the last week, we saw commentary around that. I think at the same time, we saw commentary about inflation starting to come down, really starting to at least get into the psychology of inflation coming down rather than being concerned about inflation persisting. So I think we're seeing a stronger economy this earnings season.
So let's break some of that down as we talk about economic stabilization, seeing inflation start to come down, still seeing consumers willing to spend that money on Beyonce and Taylor Swift tickets. What are some of the things that you're seeing from different CEOs on these earnings calls as they really think about the state of the consumer?
Yeah, I mean, I think the word of the last 18 months has been resilient to describe the consumer. And it's still the case that people are describing the consumer as being resilient. And I think, given what happened with interest rates rising, what the Fed has tried to do to the economy, I think everyone is still a little bit surprised that we haven't had a recession that people have expected. But still, the consumer is very resilient, continues to spend, continues to want to have the experiences that the consumer wants to have, and balance sheets are healthy at the consumer level. And so we're really seeing that continue in the economy.
And we have seen, we've seen some optimism when you talk about some macroeconomic conditions coming on these calls, not always raising that guidance, but we do see analysts raising their price targets, but we're not always necessarily seeing a lot of this guidance being raised as well. Talk about that dynamic as we're in earnings season, especially.
Yeah, I mean, I think really I would attribute that dynamic probably to the fact that we had this very large inflation that was coming through the economy that helped push top line growth along with price increases. And I think as we have basically seen that inflation come out of the economy, comps are going to start to get harder. It's going to be a little bit harder to have growth. But the flip side of that is the good news that interest rate increases don't necessarily need to increase. So the cost of capital doesn't necessarily need to go higher. So even though the economy, I think, is stabilizing from being scared of a recession, it doesn't necessarily mean that we're ready to just be off to the races from a growth standpoint.
And we've got to talk some of the big bellwethers so far this earnings season. Obviously, just heard from Disney there. A bit of a mixed picture there when it came to Disney, obviously in the middle of their turnaround story. But what have been the big bellwethers for you that you've been keeping track of?
Yeah, I think to me, some of the biggest companies that I've been looking at are in the freight and logistics space. And so we had a company last week, I can't recall who was saying that the freight recession was basically over here. But it was an important quote to me to see the company talking about how for a long time there've been a big slowdown in the logistics market as supply chains have healed post-COVID. And volumes have come down. I think between them and also Amazon having a pretty strong quarter and talking about AWS starting to stabilize, those are two pieces of commentary that have really stood out to me this earnings season.
And especially for this narrative that we're still hearing about rates being higher for longer. And then when you look at especially NVIDIA's performance and the sort of investments that companies are trying to make, what does that mean then for the rest of earnings season and some of the companies that we're going to hear from?
Yeah, I mean, I think you guys were talking about it just as we were leading in, that the retailers coming up next week will be an important indicator on the health of the consumer. It's obviously interesting. Retail has changed the dynamic of it over the last 5 or 10 years as we've gone more to an e-commerce basis. And also consumers are just swinging back to more experiential spending instead of, goods spending. So retailers kind of are de-emphasized even in terms of the health of the consumer. But still, looking forward, I think AI and technology have still been such a driver of this market, capital markets at least. Those still are carrying capital markets on their back. So I actually am thinking as well, just wondering what's the next kind of growth wind, tailwind behind capital markets here? What's the next exciting space to be investing in? I don't have an answer to that quite yet, but one of the things that I'm looking at is just as the Fed is likely to stop raising interest rates here, at least moving out duration in fixed income assets, maybe that's a place where there's some sort of catalyst, although not a lot of money to be made there probably.
Indeed, a lot of people looking for that next catalyst and obviously trying to take that cash off the sidelines, but have that fear of missing out. Always great to have you on. Scott Krizzoloff, the transcript editor and Avondale Asset Management founder. Thank you for your time this morning. Well, that does it for now. I'm Rochelle Akutho. The Yahoo Finance will be back at 3 p.m. Eastern. We'll see you then.